Good afternoon. As a designated federal officer and acting chair of the Agricultural Advisory Committee, it is my pleasure to call this meeting to order. I'd like to welcome everyone to today's virtual meeting. Before we get started, there are a few logistical items that I'd like to mention to the committee members and invited speakers. Because of scheduling issues, we're going to begin with brief remarks by Chairman Tarbert, followed by a presentation from Nate Kaufman of the Federal Reserve Bank of Kansas City, after which we will resume the meeting with the roll call and traditional remarks from the commissioners. As a designated federal officer and acting chair of the Agricultural Advisory Committee, it is my pleasure to call this meeting to order. I'd like to welcome everyone to today's virtual meeting. Before we get started, there are sorry about that. A few technical difficulties here. Back on the agenda, we'll kick it off with Chairman Tarbert, presentation by Nate Kaufman, the Federal Reserve Bank of Kansas City, and then resume roll call and traditional opening remarks from the commissioners. Couple of housekeeping items. Since this meeting is virtual, it's being broadcast. Please make sure to identify yourself before you begin speaking. Also, please signal when you have completed your comments so that we can continue with the next speaker or question. Please ensure your phone is unmuted before you start to speak and that you are speaking clearly into your device. For the committee members, please send a message with your questions to the panelist group through the WebEx chat function. At the appropriate time, I will recognize you to unmute your line and ask your questions. We will get to as many questions as possible during the meeting. If we do not get to your question, please feel free to chat or email me during or after the meeting. And just a reminder, Federal Advisory Committees are required to deliberate publicly, so please do not use the WebEx chat function to interact with other members. Finally, please keep your telephone line muted when you are not speaking. If you do not mute yourself, the conference operator may put your line on mute if they detect an interference. Now that we have the housekeeping issues taken care of, I'd like to turn this over to the committee sponsor, Chairman Tarbert, for his opening remarks.
Well, good afternoon, everyone, and thank you, Summer, so much for putting this together today. It, of course, is an honor to be the sponsor of the Agricultural Advisory Committee, and I'm excited that we can convene another meeting this year. We at the Commission sincerely appreciate that committee members and members of the public made the time to be here today, particularly those who are in the middle of harvesting your crops. That dedication is proof positive that America's farmers and ranchers have continued to do what is necessary to put food on the table for America during this pandemic, significant weather events, and these uncertain economic times. The ag industry is essential to the fundamental needs of everyone around the world, and we are reminded of that now more than ever. I often say that if the derivatives markets aren't working for the American agricultural sector, then in my view, they're simply not working. I'm also honored and humbled to serve at the helm of an agency where we try to emulate the work ethic in the agriculture sector. Even though we're physically separated, the agency's commitment to our critical mission is stronger than ever, and staff has been extraordinarily productive during the pandemic. Since the pandemic began, at least here in the United States in March, we've held 7 public meetings, issued 16 final rules, proposed 9 new rules, and our advisory committees have held 5 public meetings, and of course, we're going to hold the 6th today, right now. So given the continued pressures we're all facing because of COVID, it's important to me that we meet again to discuss what we're seeing, to hear from you, and to answer your questions. Back in April, when I established the Livestock Task Force, I said our job at the Cftc is to ensure that the derivatives markets are doing their job of providing opportunities for end users to manage and mitigate risk, and we've been doing just that. The Livestock Task Force has conducted enhanced real-time monitoring of markets such as live cattle, feeder cattle, and lean hog markets, commensurate with the increased volatility in the cash markets for those commodities. They've been engaging with stakeholders and working continuously watching for any indication that prices are moving in a manner that isn't economic relative to the underlying commodities cash prices. I want to thank the task force for their hard work and diligence. Their work to protect the integrity of our livestock markets and to ensure those markets continue to perform as intended under unprecedented circumstances has been nothing but tremendous. For example, because of their focus and commitment, the Division of Enforcement recently settled a case with a Mexican meat processing company for violating position limits in the live cattle futures contract. In times of volatility, it's essential that all market participants adhere to the rules of the road, and we will do our utmost to make sure that those rules are followed. The events of 2020 demonstrate just how important it is for all of us to work together as partners so that our ag markets continue to serve their role in price discovery and risk management. I'm grateful to the many presenters on this call today who will spend time explaining how they work to prevent fraud and manipulation, as well as highlight ways that you can help too. I hope this meeting offers valuable insight into how the futures markets function and how important transparency is to maintaining market integrity. I also want to give a special thanks to our friends at the National Futures Association, CME Group, and the Kansas City Federal Reserve for taking time out of their busy schedules to present to us today. I also need to say thank you to all of the Commission staff whose hard work brought this meeting together, especially Dave Amato for our Market Intelligence Branch of DMO, who has been working literally day and night on our Livestock Task Force. Krista Lockermeyer from our Product Review Team, also from DMO, the Division of Market Oversight, and also a consultant to our Livestock Task Force, and our first ever CFTC liaison to the U.S. Department of Agriculture. I'd also like to thank Vince McGonigal, who is the Principal Deputy Director in our Division of Enforcement, Dan Rutherford, who is the Associate Director of our Office of Customer Education and Outreach. Our team, I'd also like to thank our team from the Office of Legislative and Intergovernmental Affairs, and of course, our team from the Office of Data and Technology and the Office of Executive Director, who arrange for the technology and attend to all of the details, big and small, to make sure we hold these meetings virtually. I also want to thank my fellow commissioners for joining us today and welcome our newest members to the committee. I'm pleased that Neil Dirks of the National Pork Producers Council has rejoined the committee. Welcome back, Neil. And I'd also like to welcome Jim Fryer, who is representing the National Cattlemen's Beef Association, because the former member of the National Cattlemen's Beef Association, I think, joined our staff, Daryl Blakey. And finally, Robert Crosby, who is representing the Managed Funds Association. All three of them have joined this committee, and we're very grateful to your service. I'd also like to extend a warm welcome to Ashley Hungerford of the USDA Office of the Chief Economist and Aaron Morris from the USDA Agricultural Marketing Service. One of my goals as chairman was to increase communication and cooperation with USDA, and adding Dr. Hungerford and Ms. Morris to the AAC is an important step in building an institutional partnership. We absolutely couldn't do our work to support vibrant agricultural markets without the benefit of USDA's vast data and research capabilities. So with that, once again, thank you so much for having me. Have a wonderful afternoon. I look forward to hearing all the presentations and conversing with you. I will turn it over now to the presenters, and have a good day.
Thank you, Chairman Tarbert. Next, we are pleased to welcome Nate Kaufman, who is a Vice President and Economist for the Omaha branch of the Kansas City Federal Reserve. Nate, the floor is yours.
Well, thank you, and thanks to Chairman Tarbert and other commissioners at the CFTC for the invitation to join today. It's a pleasure to be able to be with you, and I also do appreciate the flexibility in accommodating my schedule this afternoon, and I'm glad to be able to be here and share some of the things that we've been talking about at the Kansas City Fed as it relates to agriculture. Just by very quick way of introduction, as was mentioned in the introduction here a minute ago, I am with the Omaha branch of the Kansas City Fed. We cover 7 states in the middle of the country, have had a historical concentration in agriculture, obviously, in our region, and the Kansas City Fed has had a focus in ag markets for quite some time, which motivates the the reason I think for the discussion today specific to agriculture as we track conditions more broadly for the Federal Reserve System. So Krista, if you could go forward one slide. I'll be sharing this afternoon, and I'll try to keep my comments relatively brief to make sure to leave time for questions if there are some, but want to be able to give a high-level overview on conditions related to agricultural finance specifically. There are a lot of banks that have lending exposure to agriculture in our 10th Federal Reserve District, but as conditions have evolved over the last several years, this has been an important focus for us in monitoring developments and then especially connected to the pandemic. So just to give a little bit of a outlook in terms of the themes that I want to present this afternoon, I think it's important to start with a little bit of context. First, recognizing that in contrast to the broader U.S. economy, the ag sector had been in what I would characterize as a prolonged downturn even before this year's pandemic. As the weeks and months unfolded with the pandemic, especially in April, conditions deteriorated quite rapidly. Since April, however, economic conditions in agriculture have improved slightly, but due in significant part to government payments. As we characterize the environment surrounding agricultural credit conditions, I would still describe those conditions as relatively weak, although, as I'll show a little bit later on, farm real estate markets have provided some support to those conditions. If we could go forward a slide, please. A little bit of context leading into 2020 and the pandemic that I'm sure most on the call are very familiar with. The U.S. ag economy had been weak prior to 2020, despite what we've been seeing as modest increases in farm income. So this chart shows U.S. net farm income going back to 1970. This is often looked at as a headline indicator for the U.S. farm economy. We can, of course, see the peak year in 2013 in recent years before declining sharply to the low point of 2016, and that had been a decline of about 50% in farm income. There had been a couple of years of slight increases since 2016 in farm income, and we often receive questions as we look at this chart, which the last data point is 2019, that if there's been these increases recently in farm income, where is there concern? Why is there risk? Why do we talk about the ongoing challenges in agriculture? And of course, this is, again, all leading into 2020 prior to the pandemic. Next slide, please. One of the primary reasons that I would continue to highlight the challenges in agriculture, though, next to some of these modest increases in income in recent years, is specifically the challenges connected to agricultural finance. And specifically, as this slide shows, even before the pandemic, liquidity was expected to deteriorate alongside fairly low profit margins in the sector. So it's important to keep these trends in mind before we came into 2020, despite some of the increases in income, because these reflect some of the challenges that we had been observing at the beginning of this year. A lot of questions that we would receive connected back to the 1980s, for example, which was a very difficult time in agriculture, a crisis that began with a liquidity shortage, a liquidity problem that ultimately turned into a problem of solvency, and then led to a number of failures, bank failures and bankruptcies of farms in the 1980s. The chart on the left that I'm showing on this slide is a measure of working capital in the U.S. farm sector. These data come from USDA and show a trend downward in working capital over the past really about 10 years. But importantly on this chart, in coming into 2020, it was expected that working capital would decline by about 15% even before the onset of the pandemic. So again, income had been declining slightly, but it was still a concern that liquidity had been tightening further. The chart on the right, of course, supports some of these concerns by recognizing that agricultural prices relative to input costs had also been declining. So in conversations with producers, operations, lenders, often the focus would be on low commodity prices next to costs that had been rising for a number of years following some of the peak years of profitability from 2010 to 2013. Next slide, please. I'll spend just a few minutes now talking about how these conditions have evolved during the course of the pandemic and then leading into more current conditions and then an outlook going forward. The pandemic disrupted ag markets in what I would characterize as several key ways, in several key areas. The first is recognizing that as COVID cases began to mount in late March and early April, we had a number of closures of meat packing facilities across the country and meat processing facilities. So we had tests that were showing up positive in a number of these facilities that led to some temporary closures. The chart on the left shows the production of U.S. meat production, specifically looking at cattle, hogs, and poultry. And this is monthly data. So what this shows is that by the end of April and into May, we were operating at really about 60% capacity at the worst of this crisis back in April and May. Again, the chart here shows monthly data that shows at about 80%, but a bit worse in parts of April and May. So that was the first disruption, was that we had COVID cases causing some of these temporary closures. So for farmers and ranchers that were looking to sell animals into these packing plants, they were recognizing, obviously, limitations to their ability to sell animals, which ultimately led to a sharp decline in prices that they were receiving from the farm. The second major disruption, though, was a massive shift in the way consumers were buying food products. Prior to the crisis, the amount of dollars spent on food for consumption at home relative to food purchased for consumption away from home was relatively similar, with about equal shares. The crisis ultimately led to a sharp increase in purchases being for consumption at home and grocery stores and supermarkets, in contrast to food services and schools that were closing at the time. So this led to some significant supply chain disruptions, and this has all been obviously well documented during the time. The combination of the temporary closures at meat packing plants, in addition to the shift in how consumers were buying food, led to some significant disruptions in the supply chain and ultimately lower prices on the farm. The third factor that I would consider here specifically connected to the pandemic is also the developments in energy markets. As people began traveling less associated with the pandemic in April, we saw a sharp decline in production and use of transportation fuel, but also specifically ethanol as part of that. At one point during the worst of the crisis in April and May, ethanol production had been about 50% less than what it had been pre-pandemic. That production level has rebounded somewhat, but still remains about 10 to 15% lower. So these were some of the major market disruptions that had taken place during the initial months of the pandemic in April and May. And I'll next talk about how this played out in terms of commodity prices, if we can go to the next slide. In April, prices of most major agricultural commodities had dropped sharply relative to the beginning of the year. And again, I will remind people on the line that at the beginning of the year, profit margins had already been relatively low next to what had been the case from 2010 to 2013. By April, cattle prices, for example, had dropped by about 30% relative to January, but other major commodities such as hogs, ethanol, corn, cotton, even dairy markets had also fallen further. Many of these prices have rebounded somewhat since those lows in April, but as you can see on this chart, most prices still remain lower than what they were at the beginning of the year, with the exception, of course, of soybeans due to some recent export market strength. Next slide, please. The latest forecasts do show that farm income is expected to be much higher now than a year ago due to ad hoc government payments. The chart on the left again shows a measure of net farm income that was shown earlier in the presentation, but now adding the forecast for 2020. As can be seen on this chart, a large share of income direct payments. The chart on the right, in fact, showing that the share of net farm income that is comprised of these direct government payments will be on the order of about 40%. This chart shows the history of those payments as a share of farm income going back to the 1930s, and is clear from this chart that it is quite high in a historical context, and also does not include the latest announcement of additional aid through the CFAP 2 program. Next slide, please. So we had talked a lot about the concerns at the beginning of the year about the projections for reduced liquidity and reduced working capital, and recognizing that this had been really the primary area of risk in agricultural finance for the past several years. And as each year has progressed, a feeling that there could be more financial stress that was evolving in the industry. We have seen delinquency rates on farm loans trend higher, but it's worth noting that these increases have thus far been quite modest. The chart on the left, for example, shows farm loan delinquency rates at both commercial banks and the Farm Credit System. And specifically for commercial banks, we can see the trend higher in delinquencies going back to 2015. It is worth noting, as I said, though, on this slide, that even those delinquency rates are slightly less than what we would have observed during the depths of the recession from 2007 to 2009 and the year that followed. One of the primary concerns, though, despite what I would say has been a modest increase in delinquencies, is what is shown by the chart on the right. The Federal Reserve Bank of Kansas City conducts a survey of agricultural credit conditions in our 7-state region, where we asked bankers to respond to conditions evolving pertaining to the agricultural loan portfolio. And in the second quarter, with this survey conducted the end of June, we had asked our respondents, our banker respondents, to indicate how they expected farm borrower liquidity to evolve at that time relative to the previous year and what they expected to see in the next 3 months. And as you can see on this chart, almost all of our respondents, or around 75%, in fact, said that they expected liquidity to be even lower relative to the previous year and again in the next 3 months. So again, extending some of the concerns that had already emerged surrounding liquidity in the past few years. Next slide, please. One of the primary sources of support to farm finances, though, despite the increases in delinquencies, and honestly, one component of the farm sector that has prevented more significant financial stress has been the strength of farmland markets. Farmland as an asset class accounts for more than 80% of the value of the farm sector balance sheet. So anything that happens connected to farm real estate values has an outsized impact on farm finances more generally. Since 2010, we saw a rapid increase in farm real estate values going to 2013 and even into 2014. But despite some of the sharp declines in agricultural commodity prices and farm income, and then farm income that had remained low, we've only seen modest declines in farm real estate values since those peak levels of 2013 and 2014. So for agricultural lenders that have been recognizing additional stress in their portfolios and have been concerned about the level of liquidity or working capital among their farm borrowers, they have had some opportunities in each of the past few years to restructure debt and take maybe additional equity in the form of collateral as farm real estate to shore up some of that working capital. So this has been one of the primary factors that has limited additional financial stress that we might have expected to see alongside some of the cash flow shortages the last few years. Next slide, please. Just to wrap up, and then I'll be glad to take questions if there are some. In the initial months of the pandemic this year, conditions were extremely challenging in agriculture. This would have been in mid-April or into May, as packing plants had been closing temporarily. Ethanol production was sharply lower. Consumers were not buying to the same extent that they were and in the same manner. And this was all prior to some of the government support programs that had been announced thereafter. The conditions in agriculture and the outlook at that time really was quite dire. Since then, it does appear that the most severe potential challenges in agriculture connected with the pandemic have lessened for now. I would still highlight concerns as likely to reemerge in 2021, though, as agricultural commodity prices are set to continue to weigh on producer finances. And again, the concerns surrounding liquidity have not necessarily gone away, but that there have been opportunities to be able to shore up some of that working capital with farm real estate, and then also use some of the government support programs, not just this year, but market facilitation programs in previous years, to be able to address some of those cash flow shortages, but a significant amount of uncertainty that would remain in 2021 and into 2022. With that, I'll stop, but I'll be glad to take questions. And again, thanks for the invitation and for the time today.
Thank you, Nate. Are there any questions? Please feel free to send a chat through WebEx. At this point, we don't have any questions yet, but I think everyone's getting used to the technology. But Nate, we'll let you continue on because I know you've got a busy day ahead of you. Thank you again for taking time to give us that overview. It was really insightful, and we appreciate that you were able to take some time out of your busy calendar. So thank you very much.
My pleasure. Thanks for the invitation.
Yep, absolutely. We'll have you anytime. So before our next presentation, we will go through a roll call vote, and then we're going to turn to the commissioners for their opening statements. Committee members, when I call your name, please unmute your line and verbally indicate that you are present. If you have any technology issues, feel free to send us a chat or an email, and we will update the record to reflect your presence. I will start with Buddy Allen with the American Cotton Shippers Association.
I am present. Thank you.
Thank you, Buddy. Joe Barker with National Council of Farmer Cooperatives.
I'm present.
Thank you. Chris Betts with Michigan Agribusiness Association.
Present.
Thank you. Larry Bergen with National Farmers Union. Next up, Robbie Boone with Farm Credit Council.
Present. Thank you.
Thank you. Amanda Breslin with Coalition for Derivatives and Users. Amanda? Okay. Patrick Coyle with National Grain and Feed Association.
Present.
Thank you. Rob Creamer with Futures Industry Association and Principal Traders Group.
Present.
Thank you. Robert Crosby, Managed Funds Association.
Present.
Neil Dirks, National Pork Producers Council.
Present.
Ed Elfman, American Bankers Association.
Present.
Jim Fryer, National Cattlemen's Beef Association. Jim Fryer. Okay. Edward Gallagher, National Milk Producers Federation.
Good afternoon. I'm present.
Thank you. Tommy Hayden, Commodity Markets Council.
Present.
Matt Hines, American Farm Bureau Federation.
Present.
Thomas Hogan, Cocoa Merchants Association of America.
Present.
Ashley Hungerford, USDA Office of Chief Economist.
Present, thank you.
Tom Cadleck, Futures Industry Association.
Present, thank you.
Chris Clenstein, National Association of State Departments of Agriculture. Ron Lee, National Cotton Council of America.
Present.
Randy Melvin, National Corn Growers Association. Aaron Morris, USDA Agricultural Marketing Service.
Present, thank you.
John Owen, USA Rice Federation.
Present.
Monty Peterson, American Soybean Association. Paul Riniker, National Farmers Organization. Mark Scanlon, Independent Community Bankers of America. Stephen Strong, North American Export Grain Association.
Present.
Justin Tupper, U.S. Cattlemen's Association.
Present, and good afternoon from South Dakota.
Ah, wonderful. Hayden Wands, American Bakers Association. Ryan Weston, American Sugar Alliance. And Chris Young, International Swaps and Derivatives Association. As I mentioned before, if you are unable to verbally indicate that you're present, please just feel free to send me an email and we'll make sure to update the record to reflect your presence at today's meeting. Now I'd like to turn it over to the commissioners for their opening remarks. Commissioner Quinten.
Thank you, Summer. Thank you to the members of the advisory committee. I don't have any official opening remarks this afternoon, other than just to say it's great to hear so many of your voices and with the hope that we may be able to see each other again in person soon. I've had the privilege and pleasure of meeting so many of you outside of Washington at your places of business around the country to learn about how your businesses operate and how you manage risk. And today's advisory committee is just one more tool for us at the Commission to understand that and to educate ourselves as to the challenges that the agricultural sector is facing. Started with a great report and interested to hear some feedback on that as well as the rest of the presenters. So thanks everyone for joining us today and taking time. Appreciate that. Thank you, Summer.
Thank you, Commissioner Quinten. Commissioner Benham.
Good afternoon. Thanks, Summer. Thanks to you, Summer, specifically for all your work as DFO and acting chair. Also want to recognize and thank the chairman for his leadership on the committee as sponsor. And really just want to thank all the members for your time, your service. I hope you're all doing well. It's good to hear your voices, as Commissioner Quinten said, and look forward to today's discussion. Obviously, we've been through a lot since we last met and saw each other many, many months ago, so certainly hope everyone's doing well, staying safe, and wish you all good health. And as we sort of emerge from the pandemic slowly, it's good to see sort of business as usual slightly resume, and as we work towards normalcy in the months ahead, hopefully. Look forward to seeing you both here in Washington and at home in your places of business. So thanks again to everyone for participating, and thanks to Summer and Crystal Lackenmeyer as well for their leadership and organizing, and look forward to today's discussion. Thanks.
Thank you, Commissioner Benham. Commissioner Stump.
Hi, good afternoon. I want to also extend thanks to Summer. I know putting meetings together like this is sometimes challenging and very time-consuming, but particularly in the environment we're operating in today. So thank you very much for the attention to these very important advisory committees. And I, too, wish we could be in person. For me, it's quite personal. I've known a number of members of the committee for a long time. I consider many of you to be dear friends, and I always enjoy seeing you in person, so I look forward to the day when we can be together again in person. I don't have any formal remarks, so with that, I'll turn it back to Summer.
Thank you, Commissioner Stump. Commissioner Berkowitz.
Thank you, Summer, and thank you for your work for the subcommittee, and thank you, Krista, and thank you, Mr. Chairman, for your leadership, and of course, thanks to all the members for your participation today. In this situation where we're working remotely and we can't meet in person, and we're getting the job done at the CFTC. We're working very, very hard, but there's really no substitute for face-to-face and interpersonal interactions. And I do think I also look forward to the day when we can meet in person. And in the absence of that, like this and phone calls and just keeping the lines of communication open, we really depend on it more than ever to get our job done. We're we're working remotely, and we need to hear from you and the market participants as to what the issues are and how we can best respond to them and ensure we have strong agricultural markets and a strong agricultural sector. So I really appreciate the time and effort you've put in to the various presentations today, and I look forward to all the discussion as well. Thank you.
Thank you, Commissioner Berkovitz. And thanks again to the committee and the commissioners for making time to take part in today's important meeting and for sharing your remarks with the Agricultural Advisory Committee. We know that this is a particularly busy time of the year for those engaged in production agriculture, so we really appreciate your presence. As noted in today's agenda, we will have a brief update on self-reporting from Vince McGonigal, who is Principal Deputy Director in our Division of Enforcement. Vince, feel free to get started when you're ready.
Great. Thanks, Summer. Good afternoon, everyone. Thank you for the opportunity to discuss the self-reporting program with you today. Self-reporting also includes components of cooperation and remediation, so I'll touch on those concepts as well. The interaction of self-reporting, cooperation, and remediation informs how the division may recommend an enforcement action against an individual or an entity. At the CFTC, our mission is to promote the integrity, resilience, and vibrancy of the U.S. derivatives markets through sound regulation. Enforcement is essential to fulfilling this mission because we work to foster market integrity. One way that the Division of Enforcement meets its mission is to take steps to maximize deterrence. That is, to prevent wrongdoing before it starts. We can do this through timely identification and prosecution of illegal activity and being transparent about the case filings that are made. Timely identification of matters can occur through our surveillance program, regulatory reporting requirements, and analysis of the tips, complaints, referrals from market participants, whistleblowers, and the public. A timely enforcement response can also happen through an effective self-reporting and cooperation program. The division has had advisories on cooperation for approximately 20 years now, and they were recently updated in 2017. A division advisory on self-reporting, distinct from cooperation, was first issued by the division in 2017 with a supplemental advisory concerning foreign corrupt practices issued in 2019. While self-reporting credit has been recognized in a distinct number of the overall docket of commission cases, it is one of many tools available to assist the division. In thinking about the culture of compliance, we recognize that companies have the ability to implement appropriate compliance and supervisory safeguards, to detect wrongdoing, and to report it. However, companies with even the best intentions can make mistakes, bad choices, or have bad actors. The company is then in a position to make a decision about whether to notify CFTC and to take steps to cooperate and remediate that wrongdoing. Under our advisories, if a company or individual wants to self-report, it must first voluntarily report the wrongdoing, fully cooperate, and then remediate. So for purposes of these remarks, I'm generally referencing a company, but the statement will also apply to individuals. So first, voluntarily report the wrongdoing to the division. This disclosure must truly be voluntary. It must be made before an imminent threat of disclosure of a government investigation, and it must be made independent of any other legal obligation. It must be a real disclosure designed to notify us of the misconduct. So I think what we mean here, and this is fairly straightforward, over the past 3 years, since the self-reporting program started, if a firm or entity, individual wanted to report, they easily picked up the phone, reached out, and the conversations that I've had have gone along the lines of, Vince, we've identified some conduct. We'd like to meet with the division and other appropriate divisions within CFTC. Can we go ahead and get a meeting set up? And that it begins an effective self-reporting program. The company must also disclose the misconduct to the division within a reasonably prompt time after becoming aware of it. So we definitely are interested in having a nexus between identification of the conduct, recognition of responsibility, and then the contact. I mean, we have seen instances sometimes where weeks or months have gone by, and we'll certainly consider that as part of our recommendation and determination about the self-reporting and cooperation credit that's warranted. But we think that the earlier that you can get in the door, the better it is for the commission, the division, to determine effectively the scope of the misconduct, as well as to be in a better position to recognize the steps that the entity has taken. So the company should disclose the misconduct, as I mentioned, within a reasonably prompt time after becoming aware of it. Disclose all relevant facts known to it at the time. So we recognize at the time of the first voluntary disclosure, the company may not yet know of all relevant facts or even the full extent of the conduct. But to encourage voluntary disclosure at the earliest possible time, will recommend the company receive full credit, where the company made diligent efforts to figure out the relevant facts, fully disclose the facts known at the time, continue to investigate, and disclose additional relevant facts as the company became aware of them. The company must also fully cooperate with the division throughout the investigation. So the division's cooperation guidance sets forth several factors, some of which include the following: disclosure of all facts relevant to the misconduct as the company becomes aware of them during its own investigation, including facts related to the involvement of any individuals. It's not enough to report particular facts should be attributed to particular people. We expect this cooperation to be proactive, not reactive. It's not enough just to be responsive to the division during the course of the investigation. And then third, the company must timely and appropriately remediate. Remediation is going to depend on the facts and circumstances of the particular case. So the entity is self-reported, cooperated, and remediated. What happens? Well, if the company does these things, the Division of Enforcement will, at the outset of the self-report, communicate our expectations concerning cooperation remediation. The Division of Enforcement will also recommend a substantial reduction in the penalty that otherwise would be applicable. In truly extraordinary circumstances, the Division may recommend a declination to prosecute the case. So I thought it'd be helpful to use an example of a case filing that we've had within the past year or so. And I'll generally paraphrase the statement from the order, for the most part just anonymizing the name of the entity, but to give a sense sort of how a commission order has recognized self-reporting and cooperation. After self-identifying that it was in violation of certain regulatory requirements, Entity A immediately initiated a broad internal review of its regulatory compliance program, promptly disclosed to the division the results of that review, despite not knowing the extent of its violative conduct. Following its disclosure, Entity A continued to conduct its internal review and cooperated fully with the division's investigation, as well as with the Commission's regulatory divisions, by voluntarily and promptly responding to the division's inquiries, providing frequent updates on the status of remediation work, and disclosing additional deficiencies. Entity A devoted substantial resources to remediation, acted quickly to ensure forward-looking compliance, as well as to correct its issues regarding historical reports. The entity also retained outside counsel, undertook an internal investigation and root cause analysis of the deficiency, and the conclusions reached by counsel contributed to a reorganization of the business line, including personnel changes. The prompt self-reporting of violations to the division its substantial cooperation with the division's investigation, and its extensive remediation efforts are reflected in the substantially reduced civil monetary penalty in this order. Turning to the more recent advisory on self-reporting and cooperation for CEA violations involving foreign corrupt practices. The advisory applies to companies and individuals not registered or required to be registered with CFTC that timely and voluntarily disclose to the division violations of the Commodity Exchange Act that involve foreign corrupt practices, say, for example, bribe to secure business and swaps or derivatives, contracts, or corrupt transactions to affect prices or otherwise affect the price discovery process. Where the voluntary disclosure is followed by full cooperation and appropriate remediation, similar to our 2017 advisory. In those instances, the division will apply a presumption that it will recommend to the Commission a resolution with no civil monetary penalty, absent aggravating circumstances. For example, the division will consider whether executive or senior level management of the company was involved, whether misconduct was pervasive within the company, or the company or individual had previously engaged in similar misconduct. We should note that the presumption of the recommendation of no civil monetary penalty will not be applied to registrants, however, who would have an independent duty to report. Nonetheless, we would recommend for registrants a substantial reduction in the civil monetary penalty where the registrant timely and voluntarily self-reported, provided full cooperation, and undertook appropriate remediation. The Division of Enforcement is responsible for the investigation and recommendations to the Commission for prosecution of violations of the Act and regulations. This is a responsibility that the staff and the Commission take seriously. The self-reporting, cooperation advisories provide companies and individuals an opportunity to get out in front of a Division of Enforcement investigation and recommendation for Commission action. But the companies and individuals have a choice in determining whether and how to respond to potential violations of the Act and regs. They can decide not to self-report, and if the conduct is discovered, the entity can defend themselves with respect to that possible underlying violation and be held accountable for the full range of sanctions, penalties, and remedial actions appropriate for the scope of that violation. Or they can choose to encourage a culture of compliance, proactively engage with the Commission, and obtain a publicly recognized benefit for doing so. Finally, I'd like to thank Krista for sharing some links on the slide deck, and in particular, I'd point out the Division of Enforcement Manual, which provides context for these advisories. Summer, back to you.
Thank you, Vince. And if anyone has any questions, feel free to type them in the chat, or realizing some of you may only be on the telephone here. If you have a question and you want to go ahead and unmute yourself and then identify and give your name and then ask your question, that works just as well. So we'll pause here for a quick question break. Okay, with no questions, we'll move on to the next presenter. Please feel free, if you do have a question and you think of it throughout these presentations, do feel free to chat and we can ask at another time. But our next presenter is David Amato from our Division of Market Oversight. David will provide an update from the Livestock Market Task Force. David, go ahead when you're ready.
Thank you. Good afternoon, Chairman Tarbert, Commissioners Quintens, Benham, Stump, and Berkovitz, and Acting AAC Chair Mersinger, and members of the Agricultural Advisory Committee. Thank you for the opportunity to speak today. My name is David Amato. I'm the supervisor of the Agriculture Group in the CFTC Division of Market Oversight, Market Intelligence Branch. Moving to slide 21, overview of the CFTC Livestock Task Force. In April of this year, Chairman Tarbert gave me the privilege of leading the Livestock Task Force for the CFTC. The Livestock Task Force consists of expertise across multiple divisions of the CFTC, including economists and data scientists from our Division of Market Oversight's Market Intelligence and Product Review branches, as well as the Division of Enforcement Surveillance and the Office of Legislative and Intergovernmental Affairs. The mission of the task force is to provide enhanced oversight and surveillance of livestock markets in the face of the extreme volatility and risks brought on by COVID-19. As we all know, livestock future markets are critical for price discovery and risk management for this industry. For this briefing, we would like to discuss some of the general fundamental drivers observed during this pandemic, highlighting livestock, specifically live cattle. Then I will share some of the non-confidential overall activities of the task force to date. The opinions in this briefing are my own and not necessarily those of the CFTC or the chairman or any of the commissioners. Before discussing the slides, I would like to thank Livestock Task Force members David Fickert, Alyssa Voeva, Kolev, Ann Wright, Ken Danger, and Kristen Lackemeyer for their contributions over the past several months to the Livestock Task Force. And I would also like to thank Gene Kunda, Jerry Lavin, Bob Penska, Brian Rushton, and Kelly Beck, who, although not official members of the task force, assisted the task force analytical efforts in multiple ways during this pandemic. As you can tell from that long list, the chairman has dedicated significant resources and staff to this task force. Moving on to slide 22, the COVID-19 impact on agricultural markets. As 2020 began, many of the agricultural markets were seeing relatively low prices affected by weather the previous year and trade conflicts. Starting in the first quarter, COVID-19 brought significant chaos on agriculture and other markets on both the supply and demand sides. As a result, the market observed multiple price anomalies, heightened volatility, and increased dislocations. Logistical problems and demand shifts quickly created a buildup of certain livestock products, including milk and bacon, and saw drawdowns of others, including ground beef. The livestock supply chain faced unprecedented challenges as a result of worker illness, packing plant closings, and reductions in processing. The Phase 1 trade deal between the U.S. and China stalled as the pandemic substantially affected Chinese demand. We've seen a rise in farm bankruptcies, and cash receipts for farm goods are expected to fall this year. The record $37 billion in direct payments from the federal government this year to date has helped sustain farm incomes. Government payments have risen to 36% of farm income, the highest share in nearly 2 decades. Last week, the USDA announced an additional $14 billion in aid for agricultural producers affected by COVID-19, with payments distributed likely in 2021. Moving on to slide 23, cattle, cash and futures, and box beef prices weekly. This graph shows the price relationships between 3 separate but related markets. Cash cattle, represented by the blue line, are transactions between cattle feeders and meat packers. The futures price, as represented by the gray line, is the CME live cattle futures price. Box beef, represented by the red line, is the gross price of primal cuts of beef put in boxes for shipping from a packing plant to retailers. Box beef prices soared during the virus outbreak and continued to break records. From April 17th to May 8th of this year, box beef prices more than doubled their value, reaching a record $475 per hundredweight. Since then, the choice box beef cutouts have fallen to around $220 per hundredweight. This chart illustrates how the global COVID-19 pandemic injected massive uncertainty that impacted both the cash and futures markets. As processing plants struggled during the spring to remain open, the wholesale cash and retail values of meat surged. At the same time, livestock, cash, and futures prices fell sharply, leading to large spreads between the value of a processing facility's inputs and its outputs. This is because as plants closed, the packer demand for live animals decreased, causing cash and futures prices to fall. At the same time, however, less finished meat moved through the processing system, raising prices at the wholesale and retail levels, shown via the increased box beef prices on this graph. Supply and demand has stabilized to a degree since the spring, and the situation has improved greatly. Box beef prices are now near historical averages, but as we know, this could rapidly change depending on news of outbreaks at any of the packing plants. Moving on to slide 24, U.S. cattle slaughter weekly. Beginning in early spring of this year, the packing plants were among the most significant hotspots for COVID-19 cases. On April 28, 2020, President Trump issued an executive order under the Defense Production Act, naming certain packing plants critical infrastructure to the food supply chain. During the spring, about 36 livestock processing plants closed due to issues with COVID-19. The duration of these closures ranged from a few days to weeks. Generally, the closures were due to outbreaks among workers at the plants. We estimate that pork and beef processing capacity due to closures and absenteeism fell by as much as 35 to 40% during the spring. This graphic shows the drastic drop in slaughter numbers for cattle, as you see with the collapse of the blue line for 2020. The COVID-19 outbreak reduced weekly U.S. total cattle slaughter by 38% from the March high point. The latest data, however, shows slaughter numbers for cattle have gone up significantly, up almost 45% since the low in early May, reflecting processing plants coming back online, workers returning, absenteeism dropping, and now moving toward normal kill capacities as plants work through the backlog of animals and record cattle weights. Moving on to slide 25, percent change in ag futures since January 2nd of 2020. This slide gives an overview of the relative futures price changes for ag futures prices, with live cattle, the red line, and lean hogs, the dark blue line, compared to corn and soybeans from the start of the year to present. It shows after the COVID-19 pandemic started, lean hog futures fell as much as 40%. Additionally, live cattle hit a 10-year low, down more than 35% at one point. Other ag products were affected similarly, with individual commodities declining between 10 and 40% when the virus affected the U.S. in March. As you know, the markets have since stabilized. We have seen a general uptick from the lows in April, but most ag products are still lower by approximately 10 to 20% when compared to the January numbers, with the exceptions of the grains and oilseeds that are being boosted recently by strong exports to China. Livestock markets, though, are still dealing with animal backlogs and relatively weak demand, with lean hogs still lagging by about 25% from the start of the year, and live cattle prices lagging by about 15%. Livestock prices in general remain relatively soft, and with restaurant and institutional demand continuing to be frail, it appears that this will be the case until the opening up of the full economy occurs. Moving on to slide 26, major agricultural futures 20-day historical volatility. This graphic shows levels of market stress across ag futures measured by 20-day historic volatility, which increased considerably during March, especially for livestock, and remains at elevated levels. Lean hogs volatility, the dark blue line, peaked at over 70% on an annualized basis, with live cattle, the red line, near 60%. The market observed uncertainty regarding reopening of packing plants as well as demand. This uncertainty was reflected in exceptionally high volatility in the livestock markets. The grain market, by contrast, faced less uncertainty and experienced lower volatility. As an indicator of the extreme volatility, we can use the example of price limit moves in CME live cattle futures markets. In this market, over a 31 trading day period from March 1st through April 14th, the June live cattle contract had 14 days reaching the CME set daily price limits, oftentimes moving limit up and limit down in the same week. In response, the CME has recently made significant changes effective in October to price limits in live and feeder cattle contracts, raising the limit levels and moving to a similar framework that exists in the grains and oilseeds, replacing the current fixed daily price limit regimes with a variable price limit regime that will be a price-based and reset annually. A similar change was made to lean hogs this past April by the CME. This slide demonstrates that ag volatility after spiking with the crisis has subsided. The reduction of volatility mirrors what we have seen in other commodity markets as futures prices rebound from their year-to-date lows. However, volatility remains substantially elevated as the country slowly reopens, packing plants return to normal operations, and export demand improves. Moving on to slide 27, CME live cattle futures and options market composition and price. This graphic shows the net contracts that managed money an investor class has in CME live cattle in red, and in light blue bars, we see commercial positions. Those commercial positions are producers, processors, merchandisers, and end users, both on the right y-axis and then price represented by a blue line on the left axis. The cash market that farmers, ranchers, and packers and processors deal in every day is exclusively a commercial market of buyers and sellers. However, the ag futures markets shown here have large non-commercials represented by managed money who don't participate in the cash market. This investor class makes trading decisions based on price trends. As prices go up, they buy, and as prices go down, they sell. If you look at many ag commodities since late January, you'll see a large liquidation by non-commercial managed money in the public CFTC Commitment of Traders reports of their long futures positions across the ag markets. In live cattle, the net long futures and options positions of managed money, again shown in red, dropped significantly in the spring, going from net long positions of about 90,000 contracts to slight net short positions shown as negative numbers, while futures prices, shown in blue, dropped from $130 to $85 per hundredweight. During this same time period, CFTC data shows commercials, the blue bars, reducing their net short positions, locking in at these lower prices. As we are returning to a more normal supply and demand environment, we slowly see managed money rebuilding their long positions, currently around 60,000 net long, and prices have been positively affected through this buying by managed money from the April lows in the $80 range to the $110 range we see today. The most important point from this slide is commercials and managed money traders shifted their positions significantly while prices declined and did the same in the opposite direction as prices began to rise. Moving on to the last slide, the summary of CFTC Livestock Task Force activities. The Livestock Task Force and the CFTC as a whole has been in close consultation and dialogue with the CME, livestock industry groups, and individual market participants during this pandemic. We've discussed agricultural issues ranging from convergence to price limits to market surveillance. Enhanced surveillance of all livestock contract expirations was and continues to be conducted. As an example of this work, we can talk in some detail about the April 2020 CME live cattle expiration. In April, there were significant cash and futures convergence concerns going into the last days of trading for the April 2020 CME live cattle contract. These concerns stemmed from the absence or near absence of cash markets in many locations, as packer demand for more animals evaporated and feed yard operators had limited, if any, options to send their slaughter-ready cattle due to closures caused by COVID-19. During the April spot expiration, the task force was in frequent contact with CME market regulation, market participants, and FCMs throughout the last week of trading. The task force reminded traders of the responsibility for an orderly liquidation and engaged in confidential discussions that served to make clear that the task force was watching trading activity closely. Ultimately, on last trading day, the April future rose to expire at $90 per hundredweight, and cash sale prices occurred in the $92 to $94 range, making the ending basis $2 to $4 cash over the April future. This reflects solid convergence, especially considering the unprecedented conditions in the cash market. This future expired with no apparent problems. In terms of our internal work product, this work included verbal market status updates to the commissioners and regular task force presentations to the commissioners. In terms of external work product, the Livestock Task Force has briefed the Agricultural Advisory Committee, congressional offices, other government agencies such as the Department of Justice, the USDA, the Department of Homeland Security, the Financial and Banking Information Infrastructure Committee, and the Financial Stability Oversight Council. Finally, although we can't comment on non-public analysis, I can mention one investigation, the finalization, which was announced publicly last week and mentioned by the chairman at the start of the meeting today. The CFTC brought a spot month position limit violation against the Mexican meat processor for violating June 2020 live cattle futures position limits. The order requires the firm to pay a $35,000 civil monetary penalty, and the firm is also being fined $25,000 by the CME. This case was brought in connection with the CFTC Livestock Markets Task Force and the CFTC Enforcement Surveillance. That concludes our Livestock Task Force presentation. I'm happy to take any questions if there are any. Thank you.
Thank you, David. And again, if you have questions, feel free to send a chat to the panelist group on the WebEx platform, or at this point, you can also just unmute your phone and ask your question, making sure you identify yourself before you begin speaking.
Hi there. This is Rob Creamer with the FIA-PTG. Thank you for the presentation. I was wondering if you might be able to share any observations you might have about the functioning of the futures markets during and following the volatility of the crisis. And I'm particularly curious about your observations of liquidity and perhaps any areas that could have used improvement.
Thank you for the question. I think it's similar to what I said at the last AAC when we had it in April. I think overall the markets are working in a sense as we expect. The price action is very similar to what we would expect, very similar this year, except to a much greater extent. The price movements like we saw with the Holcomb fire back in 2019. So I think in terms of fundamentals, I think the prices are reacting the way we would expect. We've done a lot of research in terms of looking at transactions, looking at who is in this market and who has been participating. We found some interesting things in terms of the liquidity. We've had the record volume that we had back at the height of the COVID response back in March. And we've done some work, looking at things like high-frequency traders. And so one of the things that we found in looking at some of that data is during this time period in 2020, high-frequency traders have accounted for about 20% of the trading in live cattle, but they only account for about 10% of the aggressive orders, which means that while we're seeing more participation, the high-frequency traders are actually providing liquidity, not taking liquidity, as these non-aggressive orders don't take liquidity from the order book. Aggressive orders are the ones that do that because they break the bid-ask spread. So I guess to answer your question, what we're seeing is we're still seeing good liquidity, and we're seeing the markets react the way we would expect. And obviously, we can't comment on any investigations that we're doing or any enforcement actions that will take place. But as things happen, those will be made public.
Thank you for that. That's very helpful, and certainly I'll stay tuned for any reports or information. I was very pleased to hear a comment right there about the liquidity providers in these markets, the algorithmic or electronic trading firms providing liquidity. It's certainly what we intend to do. But thank you for your comments.
Next up, I believe we have a question from Jim Fryer, and he's asking, wondering if you could expand upon the 1 to 2 weeks that are leading into the April expiration and the large premium of cash to futures. Jim, did you have anything to add? Go ahead and, if you want to go ahead and answer expand upon the 1 to 2 weeks leading into the April expiration, Dave, I think that would be helpful.
Oh, sure. I think the gentleman that had the question, yes, there was definitely a large premium there, and there was a lot of concern because, as I mentioned when I was going over the slides, the cash market basically was almost stagnant, and people that we talked to, the feed yard operators that we talked to, told us that they had no options for where to put their cattle. So it was a very, very concerning time for us, and I think what we saw was significant amount of work, both from the CME standpoint and the CFTC, in talking to traders, reminding them of their responsibilities. And like I said when I did the slide, we ended up at, I think, very, very good convergence given what was almost a non-existent cash market. And I think that the thing to keep in mind is the futures market did a great service to the industry because it provided the industry with price discovery. For some people, for some of the traders, it was the only place to get price information because the cash market was basically, like I said, stagnant.
Thank you, Dave. Are there any other questions for David Amato before we move on? All right, well, with that, we will move on to our next presentation. We have a team from the CME Group. Allison Kaufman, Director of the Commodity Research and Product Development. She will discuss the South American soybean futures contract. We also have Fred Seaman, who is also on the Commodity Research and Product Development Unit, and Tim Andreessen from the Agricultural Business Line. They will be on the line to answer any questions when Allison is done with her presentation. Allison, feel free to start whenever you're ready.
Thank you. Good afternoon, everybody. Thank you very much for having me. I appreciate the opportunity to be here to talk a little bit about our new South American soybean futures contract. Next slide, please. So first, I'm going to cover some of the reasons that the CME felt that the marketplace needed this tool and what key things we paid attention to in the design of the product. Then we will get into contract specifications. Third, I want to touch on cash settlement, both how it functions and some of the key benefits. And lastly, I will go into how we see this new contract working with the existing CBOT soybean contract. Next slide, please. Next slide. Have to have the fine print. So the reality that led to this product is that the U.S. is not the dominant ag exporter that it once was. Brazil has overtaken the U.S. in both bean production and exports, and so a regionally priced product made sense. Also, these markets have seen long-term correlation, but recently we had observed some breakdowns in this relationship, such that CBOT beans were not always pricing a consistent basis over Brazil or under Brazil. And as Brazil grows, the seasonality of the harvest and export becomes more important. So CBOT beans, the new crop is November, whereas Brazil's new crop occurs in March. And so those pricing cycles are not aligned for a Brazilian hedger to necessarily use the CBOT soybean contract to hedge all of their exposure. Obviously, some non-fundamental supply and demand factors like the trade war really brought the demand for this product to the forefront and signified a greater need for a tool such as a Brazilian-priced soybean futures contract. And one very important aspect here that I want to highlight is the desire for clearing to eliminate the counterparty credit risk that does exist in the paper market. So by providing a cleared instrument, we are eliminating that risk. Next slide, please. The next two slides speak to the need for the product just in a graphical sense. So I think that this graph just really clearly highlights the growing significance of Brazil and South America as soybean exporters. Just a few decades ago, the U.S. was responsible for over 80% of global soybean exports, and today the U.S. is only responsible for about under 40% of global soybean exports. So you can see on the chart just the immense growth of Brazil from almost 0% of global soybean exports all the way to the majority. Next slide. Here's another really important graphical representation of something that we've covered. Here we're looking at the relationship of U.S. Gulf cash prices to Paranaguá port cash prices. You can clearly see the impact of the trade war and how volatile it made this relationship. But even now, however, with a phase one deal in place, you can see that basis coming together in early 2020 and then re-widening to where we are at today. Next slide, please. Thank you. Here are some of the key contract specifications and salient features. There's a couple key similarities to the legacy CBOT soybean contract that I want to point out, and a couple of important differences. So the contract size parallels the legacy soybean contract, and the listed months also reflect the CBOT soybeans, with the addition of a February expiry, and that was due to customer demand for that additional month. Some important differences to discuss are the tick size. So 20 cents per ton is equal to $27.20 per contract. So it is roughly 2 times the value of the CBOT soybean contract, but not exactly. And the settlement mechanism is definitely different from the legacy CBOT soybean product, where that product is physical. This product is a financially settled instrument, which we will get into on the next slide. So I want to explain the financial settlement a little bit. Like I said earlier, both the functionality of how it actually works and some of the benefits that we see with a financially settled product. So obviously, there's 2 types of settlements, a daily settlement and a final settlement. The daily settlement, like the legacy product, is derived from trades that the market executes that day and is not directly tied to an assessment. The final settlement, however, is a numerical financial price as opposed to a guarantee of physical product. So our final settlement number is based on a Platts assessment of the price of soybeans in Santos. To generate that assessment, Platts looks at commercial trades that occur that meet the quality and quantity standards that you see on the screen. And from those trades, bids, offers, indications, etc., that Platts receives, they come up with a daily price that reflects the value of Brazilian soybeans. And for the purposes of our contract final settlement, we average all of these daily assessments during the calculation period. The calculation period includes assessments from the 16th of the month prior to expiry through the 15th of the expiry month. So, for example, the March 2021 expiry will expire on February 15th, 2021, and the calculation period is January 16th through February 15th for the March contract. So all of those daily assessments from Platts will be averaged to determine the final settlement price. Platts Santos assessment is highly correlated with pricing points around Brazil. So this methodology really allows the futures price to reflect the average Brazilian soybean price during a loading period. We see that as a major benefit to this financial settlement mechanism. And additionally, players in the market can stay in the contract through expiration without the threat of taking or making physical delivery. So it allows a potential broader pool of participants to remain in the contract for a longer period of time. Next slide, please. So one of the most important takeaways that I really want to highlight is how we see this product fitting into our existing suite. We view these cash-settled regional products as additive complements to our benchmark offering. I don't think anything shows this better than when we see a spread trade, which was in fact the first trade that we had in the new South American product. It was in South America and legacy CBOT soybeans. So we expect a similar relationship to occur with this product that we have with the wheat suite, where Black Sea wheat has not had an impact on liquidity on our existing wheat products in terms of open interest or how tight the bid-ask spread is. So we're excited to see where the market takes this product, and I'm happy to answer any questions that anyone may have. I appreciate the opportunity. Thank you.
Thank you, Allison. And if anyone has any questions, feel free to speak up or send a chat. Either way works.
Summer, this is Neil Dirks of the National Pork Producers Council.
Yes, go ahead.
And I'm not sure there's a real answer to this. I guess I would be interested at some juncture, maybe it's the next AAC meeting, with the inclusion of the South American product and the traders are far more sophisticated than my brain. But I am interested because we're seeing exchanges starting to offer risk management tools in other countries on the hog side of what we see in the future, the ability to maintain the dominant futures markets in the United States. Part of that is because from a producer standpoint, you deal with, typically a transportation differential from wherever you're at in Nebraska to Chicago for pricing, and because of the price discovery mechanisms with them. I'd be interested at some juncture to just throw it to Fred or to Tim or whoever in the future that maybe we could hear from them about more strategically as we see these go together, because I'm sure there's going to be all sorts of opportunities that are arriving with these contracts, as you made the reference on the wheat contract, for spreading and things in this order. I'm just curious. I'm trying to sort out the ramifications, because this is probably more of a statement of my desire is for our producers, it behooves us to have the futures mechanisms in this country, if nothing else, so that we can avoid transportation differentials on pricing. Just an editorial comment as much as anything, but I'm interested in Allison or Fred or Tim having any response to that.
So this is Tim Andreessen. We're happy to drill into that in more depth in a future meeting. What I would tell you is that we very much believe that having one centralized exchange where customers can manage risk on multiple products, whether it's wheat in different continents or livestock in different continents, makes a lot of sense. It provides them with the ability to spread those products. It provides them with margin offsets and a lot of other synergies. We're happy if the committee would like that to put something together and have that discussion.
I should also
Neil?
mention.
Neil, this is Fred. I was just going to add kind of your comment about the U.S. maintaining benchmark status. And what we've been doing in the grains, and Allison certainly alluded to this, and I think it's absolutely right. We have benchmark products here at the exchange, and the global market, particularly in grains and oilseeds, comes to the Board of Trade grain and oilseed contracts to manage risk. But as we've seen, the shift in global production and global exports become more, worldwide, there's a need for this regional price discovery. And we're not hearing from anyone that they're interested in replacing the benchmark. They still like the benchmark. They just like having a tool that can be used in conjunction with the benchmark to help with regional price discovery. So, that's kind of how I see that evolving, and we've got quite a bit of experience with Black Sea wheat and now South American soybeans on the grain side. And certainly, as Tim alluded to, we're happy to have that discussion going forward on any commodity that we trade.
Thank you.
This is Allison. I should mention, in conjunction with that comment, Neil, this touches on it a little bit. This contract from the exchange is meant more for an international audience, mostly customers that are already using our existing instruments and will continue to use our existing instruments. We developed this with B3 as a partner, the Brazilian exchange, and they are also in the process of launching a product that looks similar to this product, but is aimed at more of a domestic Brazilian audience, smaller Brazilian entities that may not have the ability to trade on an international exchange. So I just wanted to mention that and make sure that everyone was clear on how the B3 product differs from the CBOT product. Thank you.
Thanks, Allison. We're a few minutes ahead of schedule, so if there are other questions, feel free to speak up. Well, with that, thank you, Allison, and Tim and Fred as well. Thank you for taking time to make that presentation. We'll go ahead and move to our next team of presenters from the National Futures Association. They'll discuss the role of intermediaries in protecting the futures market from fraud. Our presenters today from NFA include Karen Wirtz, who is Senior Vice President of External Affairs and Communications, Christy Hilsman, Communications Manager, Valerie O'Malley, Director of Compliance, Abigail Campbell, Associate Director of OTC Derivatives, and Chris Bretman, CFE, Senior Manager of Business Systems and Information Center. Karen, whenever your team is ready, you can begin.
Hi, Summer. It's Karen. Can you hear me?
We can hear you.
Perfect. So good to hear you. So good afternoon, Chairman Tarbert, Commissioners Quintens, Benham, Stump, Berkovitz, and members of the committee. First off, I want to thank all the commission staff that has helped us with today's logistics. Both Summer and Krista, you've both been incredibly helpful, and I know we all have said this, and we wish we could all be there in person, but this remote platform is the best option at this time, and eventually we'll all be back together, and hopefully it's sooner versus later. I know many members of the committee, but for those that don't know me, as Summer mentioned, I am Karen Wirtz, and I am a Senior Vice President of External Affairs and Communications at NFA. I've spent pretty much my entire career in the regulatory space. We are really honored today to be asked to join this meeting to discuss NFA's role in the regulatory framework for the U.S. derivatives industry. And similar to the CFTC, as Chairman Tarbert mentioned in his opening remarks, NFA also understands the importance of vibrant, fair, and resilient markets for our end users, especially in the ag sector that rely on these markets for their hedging needs. I've known several of you as I mentioned, for a number of years, and many of you have heard me discuss NFA's important regulatory work before, and in some cases you've probably heard me say this many times. So today I thought I'd take the opportunity today to have you hear from a number of my talented NFA colleagues who are just as committed as I am to NFA's regulatory mission. My colleagues plan to cover a whole host of topics, including our thorough process to ensure that intermediaries meet both NFA's and the CFTC's rigorous standards. We'll go over our robust oversight program. We'll spend some time talking about the strong CFTC-NFA regulatory partnership, and we'll close with the important role of investor education and protection. We've got lots to cover today, so I'm going to turn it over to Christy now. Christy?
Great. Thanks for that introduction, Karen, and good afternoon to everybody. Just to reiterate, I'd like to start by just thanking the CFTC for affording us this opportunity. We're thrilled to be here with the AAC. Before we dive into our panel discussion, I'd like to start by just providing some brief NFA background information, just for committee members who may not be familiar with NFA and our important regulatory role. So NFA, the National Futures Association, is the industry-wide self-regulatory organization for the U.S. derivatives industry, and that includes exchange-traded futures, OTC derivatives or swaps, and then retail off-exchange foreign currency or Forex as well. And every aspect of our regulatory activity is overseen by the CFTC. So although we work independently of the CFTC, we are subject to their oversight, and we together act as strong partners in regulating the derivatives industry. Just by way of background, self-regulation has always played a really central role in the regulation of the U.S. derivatives markets, and that's in large part because of the historical evolution of these markets. The Chicago Board of Trade began operations back in 1848, and from its earliest days, featured a form of self-regulation to ensure that its members were dealing fairly with each other and meeting their financial obligations as well. It was only natural then that when Congress first began regulating futures markets, it chose to then build on that self-regulatory foundation that was already in place. In 1974, the U.S. Congress passed legislation that both established the CFTC and also authorized the creation of registered futures associations, or what are commonly referred to as industry-wide self-regulatory organizations. And we, NFA, were formally designated as a registered futures association. That designation was granted by the CFTC, and we opened our doors in 1982. Our responsibilities have grown pretty steadily since then. So I think that's enough about our history. Let's talk a little bit about what's happening today. So NFA's sole function is the regulation of its members. And the Commodity Exchange Act requires certain firms and individuals conducting business in the derivatives industry to register with the CFTC. And then CFTC regulations require, with pretty limited exceptions, that those firms and individuals then also become NFA members. This essentially makes membership mandatory. The basic mission of any self-regulatory body is really to ensure a high degree of professionalism and ethics for all of its member firms. So if firms were free to either join or not join NFA, precisely those firms that are most in need of self-regulation would then simply evade it. Today, NFA has just about 3,300 member firms and 46,000 individual associate members. Our membership includes futures commission merchants, swap dealers, commodity pool operators, commodity trading advisors, introducing brokers, and retail foreign exchange dealers. Our members range pretty widely in size, from huge multinational corporations all the way down to one-person operations. We're governed by a board of directors, which serves as our principal governing and policy development body as well. The board consists of both member directors and public directors. And the board is structured to ensure that we're representing each one of our NFA membership categories. And actually, I'll mention that Tom Kadlec, a member of this committee, happens to be an NFA board member as well. NFA is funded primarily from membership dues and assessment fees, and our operating budget is approximately $107 million. We also have just about 550 employees. Our largest departments, as you can probably imagine, are our regulatory departments, so futures and swaps, and then additionally our technology department. While those are our largest departments, the contributions of all NFA staff allow us to uphold our mission. That's a three-pronged mission of, first, safeguarding the integrity of the derivatives markets, protecting investors, second, and then third, also ensuring that our members meet their regulatory responsibilities. That's a little bit of background about NFA, who we are and what we do. And at this point, I think I'd like to talk a little bit more about CFTC oversight and collaboration. So as I alluded to a minute ago, CFTC oversight is really critical to our ability to effectively regulate the derivatives industry. Abby, I'm hoping you can begin our panel discussion for us. Can you just elaborate on our relationship with the CFTC and how it impacts our work?
Sure, Christy. I'm happy to start. But you will hear throughout this presentation about many touch points between NFA and the CFTC, and just how we ensure our markets are protected from bad actors looking to engage in harmful activity. Because NFA plays such an important role in the U.S. financial regulatory structure, it is essential that our activities are closely reviewed and monitored by the CFTC to ensure that we're fulfilling our regulatory responsibilities. The CFTC's oversight of NFA activities includes both formal actions, which are required by statutes or regulations, but also informal actions, which have evolved over time. At the formal level, all of NFA's most significant actions are subject to CFTC's direct review and approval. However, informally, NFA is in daily contact with the CFTC to discuss ongoing investigations, registration matters, exams, rulemaking issues, and many other issues that can arise during the course of the day. We also have regularly scheduled coordination meetings with the Division of Enforcement, Division of Swap Dealer and Intermediary Oversight, the Division of Market Oversight, Division of International Affairs, and the commissioners to ensure that the commission is aware of all of our activities. I would say the feedback from these interactions assists in our future development of our day-to-day work and is key to staying nimble within an evolving marketplace. The CFTC also performs frequent exams of our work in each of our areas of responsibility in order to ensure that we're meeting our regulatory obligations. This is a high-level overview of our main interactions, but as I stated, we will touch upon more examples throughout this panel, so I will pause there.
Great. Thanks for that, Abby. And Chris, I'll turn to you next. So when a firm or individual is considering NFA membership, the first department that they typically contact is your department, registration. So Chris, how does the registration department ensure that those firms and individuals are fit to be doing business in the derivatives industry and then ultimately grant them membership?
Just like you did, Christy, let me add a bit of background. The CFTC has a long history of delegating and assigning regulatory responsibilities to NFA. For example, over 30 years ago, the CFTC formally delegated the entire registration function to NFA. All futures professionals required to register with the CFTC are granted registration only after a thorough investigation of their background to determine if they meet the fitness standards set forth in the CEA. Firm and individual applications are electronically filed through NFA's online registration system. Once an application has been received, NFA reviews the disciplinary disclosures on each application and several other sources to determine if the firm or individual has a potential statutory disqualification that may prevent registration. The additional sources include FBI fingerprint card check results, FINRA CRD, NFA's basic system, information provided by non-U.S. regulators, and WorldCheck. The CEA outlines specific circumstances that disqualify someone from registration or a firm if that person is a principal of the firm. These include criminal proceedings, regulatory, disciplinary actions, civil judiciary proceedings, and miscellaneous other matters. Once registered, individuals and firms have an obligation to update their registration records to report disciplinary information. On a routine basis, staff monitors certain regulators' websites for disciplinary actions involving applicants and registrants to identify information that indicates an individual may no longer be fit to be registered. We subscribe electronically to sources like the Department of Justice, which sends out weekly bulletins of actions taken against a firm or individual.
And Chris, how does NFA ensure that individuals seeking registration have the knowledge that's necessary to do business in the derivatives industry?
Well, Christy, the Commodity Exchange Act requires NFA to establish training standards and proficiency testing for persons involved in the solicitation of transactions subject to CEA provisions. NFA rules require APs engaged in futures and forex activities to take and pass proficiency exams that test both their market knowledge and their knowledge of regulatory requirements. NFA recently imposed comparable requirements applicable to swaps-related activity. Specifically, NFA developed swaps proficiency requirements for APs engaging in swaps transactions. These requirements are in the form of an online learning program with embedded test questions. The swaps proficiency requirements cover a number of swaps products, including commodity products. All swaps APs taking NFA swaps proficiency requirements are required to review a section of training that addresses the application and use of commodity swap products. It also contains test questions relating to commodity-related topics addressed as part of the training section. Individuals must complete these requirements by the compliance date of January 31st, 2021. Currently, a little over 40,000 individuals have enrolled in the Swaps Proficiency online learning program.
Great. Thanks for that, Chris. And Val, can you talk a little bit about how our Futures Compliance Department, alongside Chris's registration department, assists with that registration and membership application process?
Sure, Christy. So in addition to the rigorous background checks and proficiency requirements that Chris covered, NFA also performs a robust review of a firm's operations during the application process. For example, FCMs and FDMs and independent IBs have capital requirements and are subject to a financial filing review as part of the application process. These firms must provide NFA with financial statements and corresponding supporting information, which may, among other things, include bank statements, general ledgers, and subordinated loan agreements. Along with the financials, these firms must submit a letter detailing the source of the firm's current assets, including the names of any individuals and or entities that contributed capital to the firm and the amounts contributed. This allows us to ensure that those contributing capital are properly registered or listed with NFA and that they are subject to a fitness review. In addition to the financial information, application firms may also be required to provide certain policies and procedures such as anti-money laundering procedures, risk management procedures, and procedures for handling customer complaints. If a firm intends to hold customer funds, we will scrutinize their procedures regarding the safeguarding of those assets.
Thanks, Val. So it's evident that the membership application process is deliberately pretty rigorous, and that ensures that only those firms and individuals that meet the established high standards are then allowed to operate in the derivatives markets. Once a firm or individual becomes CFTC registered and an NFA member, it must then operate its business in compliance with CFTC regulations as well as those NFA rules that we mentioned. Val, can you give some background on the NFA rulemaking process and how we collaborate with the CFTC on that front?
Sure. So as you mentioned earlier, NFA is a self-regulatory organization, and the essence of self-regulation involves identifying industry best practices in certain areas and then mandating those practices for the entire industry. As Christy mentioned earlier, our membership is diverse. Therefore, our rules must provide meaningful protections and be flexible enough to apply to all of our members. When NFA identifies areas that may require additional rulemaking, we work with our member advisory committees, industry trade associations, and the CFTC to draft proposed rules and then present those proposals to our board of directors. All rule changes approved by the board are submitted to the CFTC for approval. NFA and DSIO collaborate daily regarding registration and regulatory issues. Daily collaboration permits DSIO and NFA to address technical and compliance issues in a timely manner. We also meet on a quarterly basis with DSIO to discuss any rulemaking or regulatory issues. We welcome DSIO's input and address their concerns with very few exceptions in final rule-making proposals. NFA submits any proposals to adopt, amend, or rescind its rules to the Commission, and coordination in the early stages of rulemaking, the early making process, can greatly expedite the CFTC approval process. Once rules are approved, NFA develops and delivers education to members to help them understand their regulatory requirements. This education includes notice to members, webinars, in-person workshops, audio conferences, and online tutorials, among others.
Thanks, Val. And since member education falls pretty squarely on my department, I can add a little bit of additional color here. So to build on Val's remarks, we strive to provide ample education for our members, not only on new rulemaking and regulatory requirements, but also on new systems, common exam findings, and hot topics in the financial industry. One timely example that I'll offer is a webinar that we're holding to acclimate firms to our soon-to-be-launched annual questionnaire system. And the annual questionnaire is a filing that all NFA members are required to submit, you might guess, on an annual basis based on the name. And we want to make sure that all of our firms know what to expect when they log into that new system. We currently have just about 700 individuals registered for that webinar, so it's pretty clear that there's an educational need here. We're looking forward to that opportunity during the webinar to engage with members in real time, sharing that new system with them, and then ultimately soliciting their questions and their feedback. And webinars have long been an educational vehicle that we've utilized at NFA. And as you can probably imagine, that webinar format has been especially useful during this COVID-19 era. But speaking of engaging with members in real time, I will mention that just prior to the start of the pandemic, we also held our annual in-person member workshops in Chicago, New York, and new for us this year, London. Our workshop agendas are constructed based on input that we receive from our members ahead of those events. And in general, we do our best to anticipate member educational needs, but those workshops in particular are really great opportunities to tailor some long-form education precisely to those needs and interests of members. Before I turn back to rulemaking, I'll mention just one more educational vehicle that's available to our members as well as the public at large, and that's the NFA website. As you probably expect, our website is the most critical resource that we provide and contains a variety of member-targeted regulatory content, various publications, links to webinar recordings, and much, much more. Our website users tend to be our toughest and our most helpful critics, and as with everything else that I've discussed, we do welcome feedback. So if anyone on the Agricultural Advisory Committee has used our website and has feedback that they'd like to provide, I'd be happy to take that input. And with that, I'll turn back to NFA rulemaking. So Val, as we know, for our markets to thrive, customers must know that their funds are safe. So thinking about our Futures Commission merchant and Forex dealer members, can you give us some examples of critical NFA rules and requirements surrounding that protection of customer funds?
Sure, Christy. There are many NFA requirements and CFTC regulations to address the protection of customer funds. Quite honestly, there are too many to cover in this short time we have today, so let me highlight just a few to provide a flavor. All FCMs that hold customer funds are subject to full examinations on an annual basis. Also, all FCMs that hold customer funds report their customer segregated, secured, and cleared OTC collateral fund balances to NFA or CME Group daily. NFA does a confirmation process on FCM balances, and it's worth noting that this is a great process that we have. NFA and CME confirm all segregated, secured, and cleared OTC collateral balances on a daily basis by obtaining confirmation information directly from depositories. NFA uses an automated system that performs daily analysis of the data that it receives and compares the totals reported by the FCM with the amount reported by the FCM's depositories to NFA, and then flags material reconciling differences, which are reviewed and investigated by NFA staff. In addition to this, twice a month, FCMs file a detailed breakdown of the investment of customer funds and identify the carrying brokers and other depositories holding these funds. In addition to this, FCMs file certified annual reports and monthly unaudited financial statements for staff to review. Finally, if an FCM reduces its level of excess segregated funds by 25% or more in any one day by making disbursements that are not for the benefit of customers, a financial principal must approve the disbursement, notify NFA or the CME, and certify that the firm remains in compliance with all segregation requirements. For FDMs, a similar daily filing and confirmation for customer funds is conducted as well. In addition to this, FDMs are required to provide trade data daily to our Fortress system. This system was developed to monitor FDM Forex trading activity in order to identify potential trade practice manipulations and problematic patterns of trading activity. The system receives daily information from our FDMs and produces exception reports that assist NFA in identifying potential trade practice abuses. Now, there are many more measures that I could cover, but in the interest of time, I'll stop there.
Thanks, Val. And Abby, turning over to you, what are some recent rulemaking initiatives that impact our swap dealer members?
Sure, thanks, Christy. So just for a bit of background, swap dealers became NFA members in late 2012. Since then, we've had several rulemaking initiatives over the past few years. I'll touch on a few of them, but just briefly. So one of our rulemaking initiatives stemmed from the need to develop a swap dealer risk profiling system in order to identify firms that may pose heightened regulatory risk and to allocate our resources accordingly in an ongoing process. In March of 2017, NFA adopted our financial requirements section 17, specifying NFA's general authority to collect financial, operational, risk management, and other information from swap dealers that we deem necessary to effectively carry out our oversight responsibilities. To enhance our swap dealer risk profiling tool, NFA collects market and credit risk data from swap dealers on a monthly basis. Understanding a swap dealer's market and credit risk exposure provides NFA with insight into their risk profile. So working with swap dealers, NFA's Swap Participant Advisory Committee, the CFTC, and relevant trade associations, NFA identified a list of metrics related to market and credit risk that provide us with important information for swap dealer risk monitoring without imposing undue burdens on the firms. It's also worth noting that several years back, the CFTC authorized NFA to receive, review, maintain, and serve as the official custodian of swap valuation dispute notices that dealers are required to file pursuant to CFTC regulations. Given NFA's experiences with these notices to date, we determined that the notices would be more useful for swap dealer monitoring, risk profiling, and providing periodic reports to the CFTC if the notices contain standardized information that could be tracked and monitored across dealers and the industry. So again, we worked with the members, the swap dealers, Swap Participant Advisory Committee, CFTC, and relevant trade associations to finalize the standardized information to be filed for each dispute and to provide guidance on the types of disputes that must be reported. And I'll say here, I have to echo Christy's mention of member education. This was another great example of regulatory initiative that prompted member educational programming. So NFA held a dedicated webinar to educate swap dealers on requirements regarding both swap valuation dispute notices and monthly risk data reports at the time the filing requirements were instituted. And both topics were also covered at in-person workshops as well.
Thanks, Abby. And Val, can you give us some highlights of critical rulemaking pertaining to our CPO and CTA members?
Sure. So NFA has implemented a significant investor protection measure as a result of bad actors engaging in inappropriate behaviors. So as a bit of a background, NFA had taken a number of emergency enforcement actions against CPOs and their principals who directly or indirectly loaned or advanced pool assets to themselves or an affiliated person or entity. Many of these arrangements were used by these principals to purchase luxury items, while others went to related entities that did not have sufficient assets to repay the loans. In each case, the transaction resulted in significant losses to participants' funds. In response to this, NFA adopted Compliance Rule 245, which, with a few limited exceptions for legitimate business transactions, prohibits CPOs from permitting a commodity pool to directly or indirectly loan or advance pool assets to the CPO or other affiliated persons or entities. Now, Christy, I know you had asked about NFA rules, but I'd like to touch on a regulatory gap identified by NFA that the CFTC was able to address with its regulations. This is just another example of NFA and the CFTC working together to further enhance customer protection and close a loophole for bad actors. Specifically, this CFTC rule that impacts CPOs and CTAs became effective earlier this month and prohibits a person that is subject to a statutory disqualification or who employs a principal subject to statutory disqualification from claiming or affirming an exemption from CPO registration. NFA fully supported the proposed CFTC amendment because it addressed a gap in the regulatory framework by preventing a person prohibited from registering as a CPO from operating an exempt fund outside of the CFTC's and NFA's oversight.
Thanks, Val. And I'd like to take a moment here just to offer both you, Val, and Abby an opportunity to talk about any other recent rule initiatives or hot topics that you'd like to mention. So Val, I'll start with you. Anything you'd like to discuss?
Sure. So cybersecurity is very much a hot topic, and requirements surrounding this is essential in order to ensure the protection of customer funds and firm and customer data. NFA's rules require members to adopt a written Information Systems Security Program, or ISSP, to address the risks of unauthorized access to or attack of their information technology systems, and to respond appropriately should unauthorized access or attacks occur. Because of the differences in the type, size, and speed of members' businesses, NFA established general requirements but left the development and the implementation of the ISSP to each member. At a minimum, a firm's ISSP should address conducting security and risk analysis, implementing protective measures, having a response and recovery plan in the event were to occur, and providing training to employees. NFA has held several member outreaches and workshops to educate firms on the requirements and issued a cybersecurity questionnaire and FAQs to assist members in meeting these obligations. In the last year or so, NFA further strengthened the cybersecurity-related obligations to require members to notify NFA of certain cybersecurity incidents. Specifically, NFA adopted a narrowly tailored notice requirement where a member must notify NFA when it experiences a cybersecurity-related incident related to its commodity interest business that either results in the loss of customer or counterparty funds, the loss of a member firm's capital, or if a firm notifies a customer or counterparty of an incident pursuant to a state or federal law. This notification requirement became effective last year. Since the updates became effective, NFA has received notice filings from firms informing us of various cyber incidents, including ransomware attacks, phishing attacks, DDoS attacks, and incidents which involve the loss of customer or firm funds. NFA has a cybersecurity resources group and has hired a cybersecurity expert who reviews the incidents, including firm remediation and corrective action. This expert also supplements exam teams by conducting testing and reviews on exams, as well as acting as a resource for our exam teams.
Great. Thanks, Val. And Abby, turning over to you, are there any hot topics that you'd like to mention?
Yes, there is one. As many of you are keenly aware, the CFTC very recently issued its final swap dealer capital rules. NFA has been preparing for these regulations through developing a comprehensive project team, and we're focused on model approval, ongoing model oversight, financial filing and notifications, staff training, exam module build-out, and exam team structure. One other area to highlight that we have been focused on relates to those financial filings. So specific formats were not mandated within the regulation, but firms filing other forms, such as the 1FR or FOCUS, will be able to submit those for our purposes. However, in response to our recommendation, the final rule release highlights NFA's authority to adopt a standard filing format for our standalone swap dealers not already filing the 1FR or FOCUS, and that's a process which we have begun. So overall, NFA is prepared and ready to oversee and enforce capital requirements for all swap dealer members in the very near future.
Thanks, Abby. Now, just as effective self-regulation involves identifying industry best practices and then mandating those practices for the entire industry, it also involves ensuring that firms subject to the rules actually comply with them. So, Val, can you give an overview of how NFA oversees members' compliance with NFA rules as well as CFTC regulations?
Sure. So NFA's compliance and OTC derivatives departments, NFA's two largest departments, are devoted to monitoring members for compliance with NFA rules and CFTC regulations and investigate possible violations. Our key monitoring efforts include, among other things, risk-based examinations, analysis of member financial and operational data, reviews of retail foreign exchange trade data, and reviews of swap valuation dispute and key market and credit risk data. NFA has been monitoring and conducting exams of FCM, IB, CPO, and CTA members for more than 30 years and uses a risk-based approach to monitor them. Our computerized risk management system aids staff in identifying high-risk member firms. The risk system draws upon all of the information NFA currently has concerning member firms, including annual questionnaires, financial statements, disclosure documents, investigations, exams, registration records, arbitration filings, and firm financial disciplinary history. We also review external data such as third-party performance reporting services and compare those results to the results a member has reported to NFA. Our risk management group identifies new risk factors on an ongoing basis to enhance risk models and identify problem firms more quickly. Some risk factors include customer complaints, prior exam findings, pool investments in atypical assets, and constant positive rates of return reflected in pool quarterly reports. Currently, there are over 100 such risk factors. So, for example, if a firm were to receive several customer complaints, the firm may be scheduled for an exam sooner rather than later, and depending on the nature and type of the complaints, say, for example, a failure to return customer funds, the firm could be scheduled for an immediate exam. In addition to the risk factors used by our system, NFA has also recently started using a predictive analytics as part of our new risk modeling system to help identify member firms that should be examined. NFA has been monitoring and conducting exams of swap dealers for about 5 years now. Therefore, our risk-based approach to monitoring swap dealer members continues to evolve, and NFA recently implemented a number of significant enhancements that I'm sure Abby will touch on shortly.
Thanks, Val. Now, let's dig into what NFA's ongoing regulatory oversight looks like specific to various types of firm registrants. So, thinking about member exams, Val, what does oversight look like with regard to examinations of futures commission merchant and Forex dealer members?
So NFA is a member of the Joint Audit Committee, which is made up of a number of derivative exchanges and NFA. One of the Joint Audit Committee's primary responsibilities is to determine the practices and procedures to be followed by each DSRO in conducting examinations and financial reviews of FCMs. The members of the Joint Audit Committee meet on a regular basis to share industry developments, potential rule updates, and any changes to the programs used to examine FCMs. The CFTC participates in these meetings, and they review the joint exam programs used on examinations. NFA is the DSRO for 22 non-exchange member FCMs and FDMs, 17 of which hold customer funds. Generally, and as I mentioned earlier, all FCMs and FDMs that hold customer funds are subject to full on-site examinations on an annual basis and may undergo an additional examination on the interim basis of their segregated funds calculations. Those FCMs and FDMs that do not hold customer funds are examined using a risk-based approach. For FCMs and FDMs that hold customer funds, NFA's exams include obtaining questionnaires from the firm which outline their procedures and controls for the receipt, disbursement, investment, and general handling of customer funds. As part of the testing, examiners will conduct walkthroughs of the controls in place to ensure that they are implemented and working as designed. For example, examiners will review the process and walk through the controls an FCM uses to authorize a customer disbursement, including verifying that the request is made by a customer, excess funds are available in the customer's account, and that the proper amount is released to the account owner or authorized party. In addition to exams, we monitor FCMs and FDMs by analyzing data submitted to NFA and the CFTC on a regular basis. For example, NFA receives and analyzes the firm's certified and annual reports and monthly unaudited financial statements. As I mentioned earlier, FCMs and FDMs that hold customer funds report their balances to NFA on a daily basis. Those balances are compared to balances submitted to NFA directly from depositories holding these funds. In addition to this, FCMs file a detailed breakdown of the investment of customer funds and identify the carrying brokers and other depositories holding these funds twice a month.
And then, Val, how are exams and monitoring of CPO, CTA, and IB members different from our FCMs and our FDMs?
So most of NFA's 3,300 members are IBs, CPOs, and CTAs. So given this, we need to be smart with how we allocate our regulatory resources and target these firms using a risk-based approach. As I mentioned earlier, NFA's risk modeling system utilizes predictive analytics to aid staff in identifying high-risk member firms, and the system draws upon many key data points that NFA currently has concerning member firms in order to help us select firms to be examined. In addition to this, we also perform financial analysis of reports IBs, CPOs, and CTAs file with NFA, including certified annual reports and semi-annual unaudited financial statements filed by independent IBs to monitor capital compliance, quarterly pool reports and annual certified pool financial statements filed by CPOs, and quarterly PR reports filed by CTAs. Once we have identified a firm to examine based on all of this, NFA takes a risk-based approach for determining the scope and the extent of testing. Say, for example, on an IB exam, some risk factors may indicate issues related to the improper customer solicitation, misallocation of orders, trading strategies that may not be in the best interest of a customer, and many other areas that the exam team would then focus on.
Thanks, Val. Now, Abby, our swap dealer compliance program is significantly newer than the program that's in place on the futures side. What does NFA member oversight look like with respect to swap dealers?
Well, there are quite a few ways we oversee swap dealers. Over the past several years, NFA has developed a swap dealer regulatory oversight program that includes conducting compliance examinations and ongoing monitoring. Initially, while the prioritization of the swap dealer examinations was risk-based, the scope of all of the examinations was based on the inherent risk associated with the Chief Compliance Officer requirements. Staff have since improved its program for risk-based swap dealer exams tailored to the specific regulatory concerns of each firm by creating a swap dealer risk profiling system. The risk profiling system creates a profile for each swap dealer and weighs and analyzes standardized quantitative data submitted to NFA by its members and relevant information such as valuation disputes and market or credit risk data. In addition, the system also enables the review of qualitative data regarding information collected from policy and procedure reviews, prior exam findings, risk exposure reports, and other monitoring activities that we do. In addition, the OTC department is continuing to advance its risk-based examination approach in furtherance of more targeted and more frequent formal oversight of all our swap dealer members. And this will allow us to stay up to speed on changes within each member's supervision, compliance, and risk management programs, along with ensuring swap dealers are properly managing the risks associated with their swaps activity and that they are following all requirements designed to protect their customers. I mean, as we have seen, our swap dealer members active in agricultural and energy swaps play an extra active role in assisting and at times advising their clients in trading. So while the regulations provide parameters for our members to follow and protection to our members, we are continually working to develop our examination program so that all customers are protected, namely those end user customers who are entering swaps to hedge the risks associated with their commercial enterprises. Specifically, NFA is using new tools to review trade data and counterparty communication as part of our business conduct standards and market practice testing. So trade data visualization software is allowing our examiners to analyze and review large amounts of trade data in a very meaningful way. Data visualization has already allowed our examiners to gain a better understanding of our swap dealers trading programs, and it's improved our testing. And we are continuing to look for ways to analyze large amounts of trade data and to identify abusive trade practices. We're also using new tools to review large volumes of swap dealer communications. So these communication reviews can be broad, looking for keywords of concern across a range of salespeople and counterparties, or very targeted and looking at communication from a particular trader, counterparty, or for a type of behavior. So both with the data visualization and the enhanced communication reviews, they're relatively new to exams, But we're very excited by the exam improvements that we are already seeing from adopting these tool sets, and definitely plan on continuing to expand how we're utilizing them.
Thanks for that, Abby. So now that we've discussed NFA's rules and how we oversee members' compliance with them, I'd like to talk a little bit about what happens when firms or individuals don't follow our rules and requirements. So Val, can you give us an overview of what NFA's enforcement process looks like?
Sure. So to enforce its rules when appropriate, NFA takes disciplinary actions against its members. When NFA has reason to believe that material requirements are being, have been, or are about to be violated, NFA swaps or futures compliance departments work with our enforcement attorneys to prepare a written investigation report for presentation to NFA's Business Conduct Committee, or BCC. The BCC consists of 9 individuals who are NFA members, are associated with NFA members, or are members of the public. The general makeup of this committee is determined by NFA rules, and the committee is tasked with reviewing each investigative report and determining whether to authorize NFA to take a formal disciplinary action, which involves issuing a complaint. After NFA issues a complaint, the member respondent has the opportunity to file an answer to the charges. The disciplinary case will be resolved through a settlement or proceed to a hearing before an NFA hearing panel. Depending on how the case is resolved, the BCC or the assigned hearing panel will determine the penalties to impose in an NFA disciplinary case. The penalties may include expulsion or suspension of NFA membership, fines not to exceed $500,000 per violation, or any other penalty or remedial action that the BCC or hearing panel determines is appropriate. Historically, NFA's enforcement efforts have focused on a series of types of misconduct, including Ponzi schemes, often involving affinity fraud, improper loans or advances from commodity pools to pool operators and their affiliates, misleading and high-pressured sales practices, electronic trading platform abuses, deficient or order allocation procedures and practices, and failure to cooperate, just to name a few. One example of a disciplinary matter involving an IB involved an IB and one of its brokers. NFA had received a complaint from one of the firm's hedge customers alleging that the broker had conducted speculative trading in his account. NFA's investigation revealed a number of serious problems with the firm and its broker's activity. Namely, although most of the broker's customers had accounts that were supposed to hedge the customer's grain crops, the broker often placed unauthorized speculative trades in these accounts for more bushels of grain than the customers were expected to produce. As a result, these agricultural customers incurred significant losses on their trading activity and on their cash crops. Sanctions against the firm and the broker for this conduct included temporary bars, restitution to customers, and fines. NFA can also take emergency actions called Member Responsibility Actions, or MRAs, when NFA, with the concurrence of our executive committee, believes that action is necessary to protect the markets, customers, or the members. MRAs are typically issued after detecting some kind of fraud, many of them Ponzi schemes, and they're likely a temporary restraining order since they enable NFA to preserve the status quo and avoid further harm from occurring. Through an MRA, NFA may suspend a member or restrict a member's operations, including limiting the firm's ability to trade or accept new customer accounts. So as you may have seen, earlier this month, we issued an MRA against the firm for failing to cooperate with NFA during an exam. In this case, due to the firm's failure to provide requested documents and information, we were unable to determine what the firm and its principal did with proceeds from a loan obtained from a futures customer, including whether the principal misappropriated the money to fund his personal trading account and used some of the loan proceeds to trade futures. In this case, and with all cases, NFA works very closely with CFTC's Enforcement Division to coordinate our enforcement actions and appropriately allocate our regulatory resources. Moreover, if our exams or investigations uncover emergency situations like the example I just mentioned, then we immediately coordinate with the CFTC. We also work very cooperatively with other law enforcement agencies when we notice or suspect criminal activity. Over the years, NFA and the CFTC have brought many cases that have rapidly shut down Ponzi and fraud schemes. Subsequent criminal prosecution of the individuals involved has often resulted in significant prison sentences. So let me close out my comments with some remarks regarding how we collaborate with the CFTC and other regulators regarding enforcement. We meet on a quarterly basis with the CFTC Division of Enforcement to discuss pending investigations. The objective of these meetings is to keep each other informed and to coordinate efforts whenever possible. In addition, whenever NFA uncovers a potential ongoing fraud, NFA immediately notifies the CFTC so that it may bring action in a federal court, in addition to any emergency action that NFA might take. Finally, we may uncover suspicious activity by an entity that is not an NFA member, and in these instances, we refer such matters to the CFTC. In addition, NFA regularly joins the CFTC in meetings with the U.S. Department of Justice's Security and Commissions Fraud Working Group, the U.S. Attorney's Office, the FBI, the U.S. Postal Inspector's Office, and the Illinois Department of Securities. Additionally, NFA works cooperatively with the CFTC and federal and state law enforcement agencies on specific enforcement matters. These cooperative efforts have uncovered and led to the successful prosecution of a number of fraudulent commodity schemes with almost 30 individuals who were expelled or disciplined by NFA, receiving significant prison sentences.
Thanks, Val. So with that, we've spent quite a bit of time talking about ensuring that our members fulfill their regulatory requirements. And our member oversight responsibilities ultimately serve the purpose of protecting customers, which is really the heart and soul of what we do at NFA. We know that customers engaging in derivatives activities can feel confident in their financial decisions when they know that the firms that they choose to do business with are effectively regulated. NFA also strives to educate customers on the unique opportunities and risks that are present in derivatives activities, as well as conducting due diligence on those firms and individuals that they may be considering doing business with. So our educational efforts really focus on providing resources for investors to understand our markets, and then also to emphasize the importance of doing that due diligence. So understanding the speculative investments and also knowing the background of the firms and individuals who are offering their services. Just to kind of point on that due diligence topic, one of the most frequently accessed tools that's available on NFA's website is NFA's Basic tool, which is a public searchable database of firms and individuals who conduct business in the derivatives industry. And Basic contains, among lots of other data, current and historical CFTC registration and NFA membership information, regulatory actions contributed by NFA, the CFTC, and the exchanges and swap execution facilities as well, and specific to FCMs, financial data that pertains to net capital, segregated funds, secured funds, and then cleared swaps customer collateral as well. And while that data is utilized by a number of external audiences for various purposes, it was designed with customers in mind and is really intended to provide those individuals with transparency into the data that they need in order to make informed financial decisions. And just as important as knowing the background of a firm or a broker is understanding the products that are being offered. So one key tool that I'd like to mention at this point is called Futures Fundamentals. And Futures Fundamentals is a pretty effective educational web-based tool that delivers engaging content about the role of futures markets in everyday life and provides information on the derivatives industry. So NFA and a number of other organizations have taken the lead in further developing this resource and increasing its distribution to hopefully further that investor education and protection. Just to wrap things up, I want to note that NFA's mission today is really the same as it was 37 years ago. So our overriding objective is to help the CFTC to protect customers, protect the integrity of the markets, and also protect the public's confidence in those markets. we are very proud of our regulatory partnership with the CFTC, and we look forward to continuing to work closely with the Commission to respond to the regulatory challenges that are posed by an industry that, as we all know, is constantly changing. At this time, I'd like to open up the floor. We are happy to answer any questions that anyone might have.
Thank you so much for that presentation. If there's anyone on the phone that wants to unmute and ask a question, feel free.
This is Rob Creamer again with FIA PTG, and I was just curious. First of all, I just wanted to comment. I thought it was very helpful that you went through, covered the risk systems that you guys are utilizing, but also I think it's fantastic that you're providing resources in the area of cybersecurity to your members. Obviously, tech is a big part of everyone's business these days, and I was just wondering if you might be able to share some of the initiatives, if you have any other major initiatives in technology and at the NFA, and in particular, if you might be able to speak to your own internal efforts that you're making to secure your systems and data.
Sure, this is Val. I can take that one. Obviously technology is very important. We at NFA want to make sure that our infrastructure is kept up to date and we maintain the information that we have in a secure manner. Obviously, cybersecurity defenses is a top priority for us as well, too. We actually subject our systems to internal and external reviews, which includes SOC 2 certification audits as well as other external reviews. And other technology things that we kind of mentioned throughout the presentation, we always want to make sure that our staff and our examiners have the tools that they need to conduct their examinations and investigations in, timely and efficient manner. And as Abby kind of alluded to, we have an e-discovery software tool that, helps us review a large number of electronic communications, whether that be chats or emails, that really helps us kind of, zero in on any bad practices that may be occurring. And Abby also talked about some trade data that we system that we have that we can it's a visualization tool that we can ingest trade data from firms and then kind of use that to look for patterns of bad activity or maybe outliers in activities. So those are some of the technology issues that NFA has going currently.
Thank you very much. And great presentation.
This is Tommy Hayden. I'm representing the Commodity Markets Council, and I had a couple of questions. I was just curious how the pandemic has affected the work and the responsibilities of the NFA. That'd be question one.
Sure. This is Abby, and I'm happy to take this. So, I would say that NFA has been very agile in adapting to these new circumstances. Prior to COVID, we had already been executing remote or off-site exams. So that process was already put into play across the board. But also, when we talk about things in order to make this possible, we had implemented technology, right? And similar to what we're using today, we have WebEx. And utilizing WebEx as a software has given us access to making it, a lot easier for us to have our walkthroughs with firms. Typically when we would be on site, we would be standing over someone's shoulder, or they would be giving us a presentation. And so by utilizing software like WebEx, it's really made a seamless transition for us to be able to do our exams remotely. And so I have to say I've been very impressed, and thankfully it hasn't delayed our examination schedule and just how we've been doing things. We're just doing things a little bit differently.
Okay, great. Thank you. And just lastly, there was a tremendous amount of information provided, and I appreciate that. And you guys mentioned, the website and all of its tools. Now, if one wanted to stay current with, let's say, the priorities and developments of the NFA, would that be available on the website? If not, how would one do that?
Yeah, I could step in and take this one. This is Christy. And all of that information would absolutely be available on NFA's website. But one feature that I will point out that can be especially useful is if you go to our website and then scroll down to the bottom of any page, you'll see some functionality that allows you to then subscribe to our email communications. And that'll just ensure that you're hearing right away whenever we're issuing some new information about priorities, news, anything of that nature.
Okay, that's great. Thank you.
Thank you. Any other questions?
Summer, this is Karen. I just wanted to add just two things to the very good question relating to COVID, and Abby covered it very well by talking about we were able to pivot pretty quickly to remote working with very few hiccups. Obviously, the other thing we needed to do in the immediate short term was hear from our members and understand the struggles and the issues that they were having complying with our rules, based on rules expecting that everybody's working in the same office versus working in a remote environment. So in the short term there, we, again, had to work very quickly with the CFTC and listen to our members to understand the relief that they needed from certain regulations, but also not to, lose the effectiveness of the oversight. So that was in a very short term, we were able to react quickly there. The other thing that I wanted to say is one of the things that we've undertaken is kind of a longer view, because as we stay in this environment and we've been doing our work differently for, well over 6 months, are we really all going to go back to the same way we were working before? And, are there ways that we're learning to do things better? So we've put together a group of people at NFA that are looking at kind of the long-term view. And, again, trying to learn from what other organizations are doing as well, and learning from the CFTC. So I think there'll be more to come there as we migrate, hopefully, back to a more normal environment, but I don't think that we'll go exactly back to the way we were, that there's also a number of enhancements that we're learning about as we work remotely. But if members have any ideas and thoughts, again, member feedback is very helpful as we start this process.
Thank you, Karen. Are there any other questions for the NFA team?
So this is Joe Barker. Actually, we're CHS Hedging is a member firm, FCM, and I'm a registered individual. But I just wonder, as the CFTC has moved forward with the reciprocity with international firms, how does NFA play into the examination of the international firms as they comply with their local authorities, or how does that work to protect individuals, U.S. citizens, in those cases?
Yeah. Hey, Christy, let me take that. It's Karen, because I've been involved in the international activity for many years and very actively involved in the IOSCO activities. And NFA members, whether they're in the U.S. or not in the U.S., are subject to the same requirements and the same type of oversight. And so the borders doesn't make a distinction, but one of the things that we've been able to accomplish over the last several years is really develop strong relationships with the non-U.S. regulators and understand the issues that they're looking at when they're going to see their registrants, looking for meaningful ways to share information so that we aren't duplicating each other's work. So in that area, it's actually, quite strong, the relationships, because all of the regulators are aligned as far as ensuring that our markets are operating, effectively and are not subject to manipulation. So it's a great question, because the borders have really disappeared, but we do have really good relationships that we've developed really over the last couple decades that are helping us do our work more efficiently.
Any other questions? We still have time for a few more if others have questions.
Hearing none, we can move on to our to new business. First up is Dan Rutherford, who is the Associate Director of the CFTC's Office of Customer Education and Outreach. Dan, feel free to begin your presentation whenever you are ready.
Great, thank you. First of all, good afternoon to the commissioners and to the committee members and guests. Thank you for allowing me this time to present our new Agriculture Customer Education Resources page. Can we advance the slide, please? Next slide. First of all, my disclaimer. Like every good government employee, got to have my disclaimer. This is for informational purposes only. Any opinions expressed are my own. And also any references to studies, news reports, or any organization, trade, firm, or corporation name do not constitute endorsements, recommendations, or favoring by the CFTC. Thank you. Next slide, please. So our new Customer Education Resources page went live today. It can be found at cftc.gov/agriculture. It includes checklists, advisories, and articles. Unfortunately, in the iteration that we have up presently, we don't have the CFTC data and research, although those resources can be found elsewhere on the site. And we're going to be looking at future iterations, including some additional new research, hopefully. And so I'll cover that a little bit, but may skip over the slide that you'll see in a minute. And then a number of third-party resources. So let's just kind of quickly go through these various items. Next slide, please. The checklists were designed to help provide producers with sort of a getting started, get them off on the right foot, so to speak. These are step-by-step, single-page guides to help producers get started in working in futures and options. They're front and back. They're easy to download, easy to share, easy to print. And they can also be ordered if you have, large groups of customers, members, or students that you would like to purchase and distribute for. You can order those at the URL lower on the slide. Or feel free to email me at consumers@cftc.gov, and we'd be happy to fulfill any orders. The materials are now being printed, so they should be available for distribution in a few weeks. Next slide, please. The page also includes a number of advisory articles that we feel are relevant for the producer agricultural community, and these are timely issues or things that we feel may be helpful for producers. Next slide. Next slide, please. Next slide. We'll skip this one. We also collected a number of external resources. I mean, there's really a lot of great information that's already out there by USDA, CME Group, a number of universities and nonprofits like Andy's Project. So we felt that it was important to highlight those resources and make those available rather than try to reinvent the wheel. Next slide. But really what this page is about, and as we go moving forward, it's really going to be central to a new initiative that's currently in the planning stages that will center around a number of key elements, the first of which being a risk management planning guide with associated videos that'll reside on the page to assist with the learning. And really, the program comes with a number of planned learning outcomes at this point. We want to help agricultural producers make better decisions when it comes to managing price risk through planning. When you have a plan, it reduces the likelihood of making heat-of-the-moment decisions or being influenced by fraudulent offers. A second outcome that we would like to see come from this would be increased knowledge of commonly used hedging strategies. Again, we hope to provide them with realistic expectations that would help them avoid too good and true offers. Other outcomes we hope to provide include increased knowledge of commodity futures, options, and swaps markets, awareness of fraud and abusive practices and how to spot and report problems, awareness of their customer protections, and building skills necessary to select and implement a risk management strategy. We'll do this by developing original content and through partnerships with other groups. The Risk Management Planning Guide will introduce farmers to risk management process including common risk management strategies, products, market mechanics, basis and fees, customer protections, redress, and ensuring they are working with legitimate financial service providers. The series of online videos that we hope to produce will be curated in an easy, searchable, SEO-optimized, knowledge-based format that will supplement the RMP and provide a growing repository of answers to producers' questions over time. In terms of research, what we hope to do is recommend research around producer attitudes and behaviors when it comes to hedging, market confidence, and use of forwards, futures, and options strategies. There has been a limited amount of research in this area. We know that, for example, a majority of producers don't use futures and options contracts, and we want to find out why that is, what may be preventing them, what problems or trouble areas they see when it comes to using these products, and are there educational means in which we can aid that process. And as we build out the program and develop the program, we'll be holding a number of roundtables and listening sessions and public presentations, and those events and announcements and other news will also be available on that page. Next slide, please. Finally, our other work, this is some of the more recent work that we've completed in the Office of Customer Education and Outreach. We continue to provide anti-fraud information and advisories around the coronavirus pandemic and issues related to that. Coming up, we have World Investor Week, and we're working very closely with Karen and the team from NFA on putting together a webinar for that and conducting outreach, and also working with teams from the SEC, FINRA, and other organizations. We recently redesigned the Learn and Protect section, including updating the red list, producing a number of advisories and articles, developing a publications page and videos. So we hope you can spend a little time and familiarize yourself with the new elements on the website. And we've increased our social media outreach. And we also continue to collaborate with federal, international, and private sector partners, including the Financial Literacy Education Commission, IOSCO, and the other participants in the Futures Fundamentals programs. And that does it for me. Are there any questions?
This is Jim Fryer from NCBA. I just have one comment. As far as producer education, and this is one thing that our organization is working on too, so if ever in the future there's overlap, we'd like to listen. Thank you.
Sure, I'll be happy to get your information, and we can definitely connect, because that's certainly one thing that we're looking for, is how to make partnerships in this space.
Very good.
Thanks, Dan. Are there other questions for Dan? All right, thank you so much for that presentation. The next order of business on our new business agenda, and I'm going to turn it over to Krista Lachenmeyer from the Division of Market Oversight. She is also our newly appointed AAC. She's also going to be joined by our newly appointed Agricultural Advisory Committee members from the U.S. Department of Agriculture. Many of you know Krista from her product review work in the agricultural markets. Krista is also a consultant on our Livestock Task Force and our newly appointed CFTC liaison to the USDA. I also have to say a huge thank you to Krista for all of her hard work in putting this meeting together. I cannot thank her enough for her assistance and guidance in making these meetings happen. So thank you very much, Krista, and I will turn it over to you now.
Great. Thanks, Summer, for those kind words. I really appreciate it. It's been a pleasure working with you to plan the last two meetings. You work equally as, if not more hard, so I'm happy to have been a co-conspirator with you. Thanks also to the Chairman, Commissioners, CFT staff, and AAC members, and all of our presenters for making this a great event today. I'd also like to give photo credit to Summer for this slide. It is her family's farm in South Dakota. So I'll start with the subcommittee update. The AAC members may recall that during the April 11th, 2019 meeting in Overland Park, the committee voted to form a subcommittee to review recent requests for approval of amendments to agricultural futures contracts and make recommendations for staff policy around that. The Commission recently and unanimously approved the formation of that subcommittee. So on Tuesday, we will publish a notice in the Federal Register soliciting nominations for that committee. Subcommittee membership will be open to all, and that includes exchange staff and academics, which is a little different than the regular committee membership. Of course, all AAC members are willing or able to self-nominate or be nominated to serve on the subcommittee. So by way of background, the Commodity Exchange Act requires exchanges to seek Commission approval when amending futures contracts based on agricultural commodities as defined in Section 1A9 of the CEA. The CEA provides for approval, but it does not identify the standards upon which the Commission should evaluate an exchange's implementation plan. So that is separate from the substance of the rule. So for example, how changes to terms or conditions impact the value of existing positions, how the exchange should assess market conditions in deciding, announcing, or implementing amendments, or the timing and implementation of amendments. Recent history suggests that Commission guidance on these issues may help exchanges limit risk to both the exchanges and market participants, so exchange staff requested Commission input on this issue. So I would like to thank my colleagues in the Division of Market Oversight, Summer, our DFO, Chairman and Committee for their support in this initiative, and we look forward to updating you on the subcommittee and its progress. For the USDA liaison update, I'd like to start by echoing the Chairman's welcome to our newest AAC members from the USDA Office of the Chief Economist and Agricultural Marketing Service. The research and data products of these offices are absolutely integral to the operation of the futures markets. I think many of you also know that the AMS staff actually provides the grading services that make the live cattle delivery process possible. So welcome to you both. Secondly, we wanted to let the committee know that we have some additional meetings scheduled in the near future to discuss collaboration on customer education and outreach as recommended in the USDA's analysis of beef prices in the aftermath of the Holcomb fire and during the pandemic. Both agencies are committed to ensuring producers have available optimal risk management tools that they trust. I would now like to hand it over to Ashley Hungerford to talk about some of the cooperative agreements that the Office of the Chief Economist has entered into and changes to the livestock crop insurance program. She will be followed by Aaron Morris, who will discuss the upcoming data users meeting. Thank you, Ashley, and again, welcome Ashley and Aaron to the Ag Advisory Committee.
Thank you very much, Krista, for the warm welcome. It's very much appreciated. I'm glad to be here. So my office in USDA, the Office of the Chief Economist, is currently engaging in multiple cooperative agreements with universities for the upcoming year. But there are two that I would like to highlight centering around cattle markets. The first being with Texas A&M University. This work on cattle markets includes regional and national workshops, along with a set of commission papers on current issues and trends in the cattle market. Texas A&M will be engaging with experts from around the country, including private industry members and industry associations, to ensure this research has appropriate regional representation. They will also be looking at a second area concerning beef packing and looking into certain questions such as what are the impediments to expansion for both new and existing firms of varied sizes, and what are some common success factors for small and medium packing plants, and is there a set of generalizable strategies for success? OCE, Office of Chief Economist's second cooperative agreement on cattle markets is with Kansas State University. They'll be assessing the relative market thinness concerns and whether thinness of cattle markets is detrimental for overall market effectiveness and efficiency. Kansas State University will also be looking at at market information needs and surveillance mechanisms necessary to ensure longer-term marketing contracts and formula trade in fed cattle are competitive as cash negotiated trade that is currently used as the base price may become progressively less reliable over time. So that concludes the cooperative agreements. And then, as you mentioned, there's been some recent updates in livestock insurance. Livestock products have been available for almost a couple decades now, but it's pretty small as far as the crop insurance portfolio is concerned. There's two main types when we're talking about beef cows or beef cattle and swine. There's the livestock risk protection, which is just a price protection policy. And then there's livestock gross margin insurance, which is that difference between the animal price and feed price that can be insured. The major changes that have recently occurred is a doubling in the head limit. So feeder cattle and fed cattle are under separate policies, and now the annual limit on that is 12,000, whereas before it was 6,000 head a year. For swine, the annual limit on a policy is now 150,000 head per year, whereas previously it was 75,000. Also for these livestock policies, in particular this is livestock risk protection, there is an endorsement length increase for swine. Now price can be protected up to 52 weeks out. Previously it was 26 weeks out was the furthest endorsement that you could have for swine. And then along with these policy changes, new feeder cattle and swine types will be created under the livestock risk protection that will allow for unborn livestock to be insured as well against price declines, Also, there has been subsidy increases to these policies. Recently, the livestock risk protection has undergone premium subsidy increases. And for livestock gross margin, subsidy has been added to the cattle and swine policies. So that concludes my updates on my end. Thank you very much, Krista.
Sure. Erin, are you able to speak? I am, yes. Thank you. Thank you so much for the opportunity to be here. Really appreciate it. And as a few other folks have highlighted, I think USDA and CFTC have been doing a lot of collaboration and look forward to working more closely together. So I know I'm one of the last things standing between us and being finished, so I will keep this brief. I just wanted to take the opportunity to mention the upcoming USDA Fall Data Users Meeting. I think many of you are familiar with that event. It's a great opportunity for the Agriculture Marketing Service as well as our fellow other USDA data agencies to really come together and host this event for our users, talk about upcoming changes, new products and services, etc. So this year's meeting will be the afternoon of October 28th, and like most other things in this current climate, it will be a virtual meeting. Hopefully we can have it again in person soon, one of these days. Just wanted to highlight a couple of the breakout sessions. There'll be a What's New with NASS session, as well as a session on using satellite data. AMS is going to be talking about ways that we ensure the accuracy of our market news reports. And finally, there'll be a session on foreign production, trade, and export data and some weather things as well. So hope to have a lot of participation, and thank you so much for your time this afternoon, and thanks again for having me.
Thank you so much, Krista, Ashley, and Erin. Now I'd like to open the floor for any additional questions or comments from our committee members. Go ahead and unmute if you have additional questions or comments.
This is Jim Fryer, NCBA again. I believe this question is for Ashley, and I'm anticipating and excited to hear about some of the LRP changes, and the one specifically about unborn livestock that will have potential to have price risk protection. Is that something that needs to go through the Farm Bill, or when do we expect that to be available?
I know for a fact it does not have to go through the Farm Bill, and I believe that was coming up in the next year, the next crop year, which is just a calendar year for cattle. So that should be out for 2021 policies.
Very good. Thank you.
Mm-hmm.
Thank you, Jim. Any other questions? Feel free to chime in. All right, hearing no additional questions, I want to thank everyone for joining the meeting today. If you missed anything, we will have the transcript and recording of this meeting up on our website in the near future, so you can always go back and listen again. We know this is a really busy time for everyone, so we really appreciate everyone taking time to participate in the meeting, and a special thank you to our presenters for taking time to prepare and present. With that, the meeting is now adjourned. Thank you so much.